increase their push toward fossil fuels and away from some of the renewables that we've been seeing?
Gouging, Bramo. That's what it's about.
Well,
greed.
I'm not saying that they're gouging. I'm just saying I wonder when they're going to start talking about that again.
Still, with taxes, and John, you've lived this. I looked up yesterday, in the United Kingdom, a gallon of gas is $5.40.
I think it's,
and here it's $3.50. I can't remember the compare.
I think close to $1.50 a litre sterling.
I don't do that. I can't do that, John. It's like fenning and farthing.
It's expensive.
Shilling.
Well, we're not using penny farthings.
Did you do
anymore.
shillings?
I didn't do shillings. I wasn't around for shillings.
God, I read Dickens and I just don't even know what they're saying.
Far too young for shillings, Tom.
Yeah, you read Dickens and you're like, how the hell do they keep track of this stuff?
Well, clearly they changed things so that you could keep track of things, Tom. Yeah, you seem like a man that would have lived with shillings. Would have enjoyed it, too.
I tried.
Tossing people shillings, walking along. Would you have had a cane?
Yeah.
Would have.
No, you get the cane with a little knife in it in case the bad guys go after
a little knife at the end of the
Yeah, that's like,
From like Mary Poppins.
We should do.
Oh, it's Sherlock. I read all the Sherlock Holmes.
You would have made a great Scrooge. Never mind Michael Caine. Can you imagine? That would have been a great remake. If they'd given you the job instead of Michael Caine, that would have worked. Equity futures. It's almost there. Humbug. Up 0.17%. It's Fed decision day. Up next, someone who called this market rally in early April, looking for a breakout. That's what we got. It's Anastasia Amoroso of iCapital.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From the wizards and capitals to new ventures and innovative investment, running a sports empire in Washington, D.C. is a monumental task. Owner Ted Leonsis trusts CFO Peter Bichet to execute monumental sports and entertainment's financial game plan.
We are definitely in growth mode. What else can we do? How do we grow the platform?
Watch Chief Future Officer today on Bloomberg.
We think we're sitting towards the top end of a very strong rally.
The Fed has made significant inroads in the battle against inflation.
What's left behind is a lingering higher inflation rate than we would like.
I think that the Fed isn't done, and I still don't think it's going to cut rates quickly.
If I were a voting member of the FOMC, I would vote for wait and watch.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
That vote is just around the corner, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on quite a run year to date and since this Fed started hiking. On the equity market right now, equity futures up by 0.2% on the S&P 500. TK, we talked about this in the last hour. I think we need to do it again. When the Fed started hiking, the S&P 500 closed at the level, Tom, a level below where we are right now. This equity market is positive through the hiking cycle. It's positive through banking failures. We've had a bear market, and for many people, we're back in a bull.
I mean, you're better at the dots than I am. I don't believe in the dots, but the basic idea is the great miscall of the last 6 months is a recession. Matt Luzetti of Deutsche Bank absolutely nailed it. He had the courage to put a date on it, and his date was way out. We're not even yet to the Luzetti mark, and the answer, a lot of other people were sooner, and maybe including many Fed members, and the answer is the recession hasn't happened. Stock's up.
It's a three-part act today. We've talked about that a few times. You'll get the statement, the projections, the presser. Let's talk about number two, the projections. There is a belief. A lot of people believe this, that today you're going to have to upgrade GDP, downgrade unemployment, and maybe just give a little nudge to that dot plot a little bit higher to imply that we can go again.
Because the reality is they're not going to want to signal that everything is fine and that a soft landing is the best base case and Tom is falling asleep or something. He's grunting. But I will say there is this concern that we have going forward about where they see the potential, the sort of asymmetric risks of inflation restarting later versus having already done enough.
What is the efficacy of the dots? What is the value add of the dots other than know what Bullard thinks?
Signal. End of story. Today, if you want to demonstrate, if you want to demonstrate today that the pause doesn't mean you're done, then you need to have something baked into the median dot. And I think that's why, to some extent, I mean, this is a guess. I would imagine that Chairman Powell might welcome some dissent today. If you want to pause and communicate to the market that we're not done, then it would be nice if some people on the committee put their hand up and said, I don't think we're done. I think we need to do some more.
It creates the uncertainty that they would welcome that potentially could tamp down on unwanted exuberance, as Bruce Kasman said. I am wondering, though, again, their credibility. They can move these dots around like they can move anything around. It's not like they're, committed to the dots. It's not like it's actually fantastic kind of messaging. So, this is the real problem that they have on their hands. When they signal, when people talk about more work to do, is it in holding rates or is it in having rates materially higher? It's unclear.
I think we've all said on the record that if the Fed had a choice, they would have got rid of this dot plot a long time ago. It's kind of been quite confusing at times, and maybe today is one of those days. But ultimately, the belief is today, consensus view, no hike, but communicate you're not done. You're going to look at the data as it comes in. Some people do think we will get a hike today. Let's be clear about that. I know the consensus view on the street.
Is Hollenhorst still there?
Hollenhorst is still there over at Citi. He still believes that inflation is still stubbornly stable. I think that's the word he used. Interesting term there in his note yesterday.
With great respect, I'm just suggesting the monetary and financial mathematics, which Governor Krosner is expert at, is secondary to an analysis of domestic final sales versus international import inventory dynamics, say, off of a weakening China. Does a weakening China have more to do with where this Fed is going than the dots? I just think we got to get back to basics here, which is everyone, including me, has been wrong about a buoyant, resilient American GDP.
Big time. Yeah.
Big time.
Everybody we've spoken to. Couldn't agree more. Equities right now on the S&P 500, just about positive. We're up by 0.2%. The stage is set as follows. The scores look like this. Yields up about a basis point here, Lisa. The 10-year, 3.82.
Let's get the times of some of the key moments of the day. 8:30 a.m. We didn't even talk about this. We get PPI, the latest read after yesterday's CPI. This is more manufacturing input prices that have come down much more sharply than what we've seen over in services and beyond. Just curious to see how much this gives a tailwind to some of the earnings, perversely, in the S&P if the input prices are coming down. 2 p.m. is the FOMC rate decision. Fed Chair Jay Powell will take the helm at the news conference at 2:30. And we do have our Fed special starting at 1:30 p.m. Eastern time. We have Randy Krosner, former Fed Governor, Matt Luzetti of Deutsche Bank, Michael Collins of PGIM, and Seth Carpenter of Morgan Stanley, among many others, John, to kind of parse through what a hawkish skip might mean.
Great lineup. Looking forward to it. With us around the table, Anastasia Amoroso, Chief Investment Strategist over at iCapital. Anastasia, good to see you.
Good to see you.
I remember you sitting around this table with Tom and I maybe several months ago, I think early April. I think it was Good Friday, Payrolls Friday.
Good memory.
And you made the call that we would break out to the upside on the S&P 500. You forget everything. Had a really tight trading range up until that point. We've broken out. Everyone's on board with that move now, seemingly, or at least slowly they're capitulating. Where are you now? Do you have this view that we broaden out, or do you want to de-risk and take some of those profits?
I do think we're broad now, John, and I think we have been doing that for the last couple of weeks. And, you know, the reason for that, as Tom, you were just talking about, is this U.S. economy has been so much more resilient than anybody has expected. And so as a result, we've gone through the earnings downgrade cycle. And if you look at the earnings revision ratio, it is actually now positive for the last few weeks or for the last month or so. And so that instills a lot more confidence in the EPS part of this equation. And then, you know, at the same time, the Fed, whether it's a skip, whether it's a pause, the reality is they're not going to go 75 basis points for consecutive more meetings. So we're done with that. So we can have some stability in valuations as well. So that's why I think this rally does broaden out.
The simple question is Apple under-owned? But far more than that, is it your take that the institutional money, typical fundamental buy, hold for 3-year money, has missed this market move and there's a general statement under-owned?
Massively under-owned, Tom, and a lot of investors found themselves in chasing mode. And first, it's kind of the high-velocity money, the systematic traders, the hedge funds, and guess what? They all piled into this market, and that's what propped it up higher. But then you look at the bond and cash flows and what they have done versus the equity outflows. There's a massive amount of capital that could potentially pivot here. And I think this capital is going to be looking at valuations and saying, well, technology has had its run. By the way, I still want to be a tech investor, just want to be a little bit prudent about taking some tactical trades off. But the money is going to look at valuations and say X technology, the multiple on the S&P is actually in line with its 10-year average. So that's why, John, I also think this rotation can broaden out. And I also want to bring China into the equation as well, because as pessimistic as everyone is on China, the great news there is China's CPI inflation is 0. You know, policy rates are higher. There's room to cut rates. There's room to stimulate in China. And the last few weeks, we've really seen the willingness of the policymakers to step up the stimulus, at least for now talk, but I think measures as well.
Given that backdrop, if the Fed does have a skip, hawkish, whatever you want to call it, will that unleash unwarranted exuberance in risk assets in the U.S.?
I mean, it already has, right? We sort of pre-traded the pause, the skip. And, you know, I think this exuberance is somewhat warranted. And by the way, if you go back in history and if you look at rate hikes, you know, the Fed hikes rates, but it doesn't cause an imminent recession. There's typically a period of time before the recession onsets. And there is this exuberance phase. I think some call it euphoria, where the market rallies for the 12 months after the Fed actually ends its hiking cycle. But the reason it rallies, Lisa, the reason I say it's warranted is because the economy is still hanging in there and the earnings still hang in there. So I think this exuberance might be justified.
What's the tipping point? Let's say the Fed does hold rates here for a long period of time. When does the tipping point come? When perhaps the pain starts to get felt, when perhaps this exuberance starts to wear out?
I think the Fed would need to go higher and potentially much higher to really crack this economy. And, you know, I say that because if you look at this economy with 5% rates, yes, we're feeling strains here and there, and there's pockets of dislocation that are to come. But by and large, this economy is doing just fine with 5% rates. So I think you need to raise rates to a much more restrictive level for something to really crack that would cause the crack in the unemployment rate.
Within your macro view, does a 60-40 allocation work? I can't make the math work in my head. Are you a 60-40 type, or do you have to go to a different mix?
Well, this year, anybody who's declared 60-40 to be dead obviously has been wrong. 60-40 is one of the top performing things out there.
Off of a miserable year, granted.
Yeah, exactly. But if you look, Tom, over the last 3-year, 5-year, 10-year, 15-year period, and if we expand beyond the 60-40, and if I broaden that out to private market strategies like growth equity, like venture capital, like private equity buyout, like private credit, all of those things have actually outperformed the 60-40. So we want to look beyond the 60-40, and it's not just something that worked last year. I think that's something that works for the next several years.
Just to build on something you said about the labour market and how far Fed funds would need to go, Where does that leave the bond market? Never mind equities, let's put stocks to one side. Where does that leave fixed income, treasuries? What does a 10-year look like over the next 12 months?
Yeah, I mean, I think the 10-year is supported around these current levels because, if the Fed needs to go much higher, the front end of the curve rises, but the back end really doesn't because it's a function of the forward growth expectations. But if the Fed continues to hike rates, that means the recession probabilities likely rise. So I actually think the 10-year offers, decent value around these current levels. And also, if we are wanting to prepare for a 2024 recession, that's what you buy. You buy the 10-year, you buy the 30-year, and I think that's a great balance to maybe some of the cyclical stuff in the portfolio.
You think we're at that point now to make that move currently?
I think you can. I don't think you have to imminently hedge a recession, but I think if you're buying some 10-year treasuries into your portfolio, I think they can provide some stable value because, again, the growth expectations are not likely to spike materially higher. Inflation expectations are not likely to move materially higher, so I think that's going to keep the 10-year anchored.
Anastasia, awesome call on the equity market for the year so far. Thank you. Anastasia Amoroso there.
I didn't listen to her.
You should do, TK.
Triple
it's usually the polite thing to do is to listen to your guests.
I just
lever
didn't believe her.
QQQs.
Yeah,
didn't believe her.
That's better. Are you in cash now, Tom? You coming out of cash?
No, we're there, and the gross up has been so great with that 5% coupon that we're slotting in a 16% gross yield. And you take the 2 and 20 off of it, and then net clean to the clients. It's really worked out.
2 and 20 on cash.
Yeah,
it's quite a business you're running there.
Thank you. Net clean to clients. We've got a new ETF coming out that'll be great.
Oh, we can't wait for that, TK. Looking forward to that. Coming up on Surveillance, Mike Schumacher of Wells Fargo. We'll talk about the bond market with him. Look out for that. Elisa, the Federal Reserve just around the corner, a height, skip, and a pause, and I think everyone's sick to death of this conversation, aren't they?
Yeah, although it's changing a little bit. Anastasia was really talking about that. Much more restrictive. What does that look like? Do they start gaming out their understanding of why this economy has remained so resilient?
It's going to be interesting today, 2 o'clock. You know what we're going to be running?
What's that?
Bramo dissents.
Lisa dissents?
That's going to be
Bramo dissents all the time. Bramo dissents all the time. In fact, I think a lot of people would prefer Bramo was on the committee so someone could actually dissent at the Federal Reserve. If you are just tuning in, welcome to the program and good morning to you. Live from New York City. Your equity market up 0.2%. Coming up on Bloomberg Surveillance, Mike Schumacher of Wells Fargo, David Balin of Citi Global Wealth, Mike Wilson of Morgan Stanley. Mike Wilson, a conversation you do not want to miss. We're going to take place, that conversation, about 8:15 Eastern Time. This is what Mike had to say coming into this week. The S&P 500 has crossed the 20% threshold. More are declaring the bear market officially over. We respectfully disagree due to our 2023 earnings forecast. His call on the earnings is something that he's stuck with for the whole of this year. When does that more pronounced weakness, Tom, start to come through? We talked about when earnings season begins, July 14th. JP Morgan.
Everybody has a belief construct in that, and what's interesting to me is to start at the top of the income statement. Earnings are defined down any number of levels, EBITDA, operating income, even gross margin up higher. Forget about it. Go to revenues at the top, and if you get a persistent inflation, by definition, you get a better nominal GDP, which means, and I use Honeywell as a proxy, instead of a surprise 8% revenue, you don't go back, Lisa, to 4 or 5%, but you get 6.8% revenue, and that's the beginning of a better earnings structure.
Although I wonder if it's a tale of two different types of companies, because smaller companies are seeing a bit more pressure.
Oh, yeah.
So how much does that really highlight some of the weakness that we could see?
Live from New York, the conversation will continue, counting you down to Chairman Powell on a Federal Reserve decision, looking for a skip, a pause, call it whatever you want. Just don't call it the end of the cycle, apparently, if you work at the Federal Reserve. From New York, this is Bloomberg.
multi-trillion dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
From New York City,
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Will the Fed pause or hike?
The steepest tightening cycle since the 1980s may be about over.
It's a we've never been here moment.
And where will they go from there?
They may leave the door open to additional rate hikes.
They say pause and this market hears cuts.
Trust Bloomberg for the fastest coverage and exclusive analysis.
What could potentially torpedo this?
You're not really seeing the slowing in the labor market.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
This is called election interference and yet another attempt to rig and steal a presidential election. I had every right to have these documents. I will appoint a real special prosecutor to go after the most corrupt president in the history of the United States of America, Joe Biden. They're not coming after me, they're coming after you, and I just happen to be standing in their way.
The president on the campaign trail, the former President Donald Trump, fighting back after pleading not guilty to the charges of alleged mishandling of classified documents after appearing in court in Miami yesterday. This morning, today, good morning to you, counting down to a Federal Reserve decision just around the corner later on this afternoon. Consensus view is no change, a skip, a pause, but ultimately a Federal Reserve that is unwilling to communicate the end of the hiking cycle. That's what many people expect. Going into that, your equity market positive by 0.1% on the S&P 500. Set up as follows in the bond market, yields just about unchanged. The 10-year at 381.73. And in the FX market, slightly weaker dollar, stronger euro, 108.08. TK, the moving crude, $70.31, positive by 1%.
Great conversation with Rita Sen there. I find really a high point so far in our hydrocarbon discussion is her agreement with Jeff Curry here over the interest rate structure. And that interest rate structure affects everything, including what we're going to see at 2 p.m. this afternoon.
Torsten Slok just published over at Apollo. More demand destruction needed to get inflation to 2%.
Yeah, okay.
How much demand destruction will we see between now and July? To Bruce Kasman's point over at JP Morgan, it's a very short window between now and the July meeting. There's not a ton of information this Fed's going to get to make a decision as to whether they need to go 25 or not.
All of a sudden, it's a short window to the end of the year, quite frankly, as well. And to the Slok note, demand destruction, the issue is on the supply side, we still have massive pandemic dynamics that they're going to struggle with today.
I'll read you the notes on. The stock market thinks we have the worst behind us, which shows that earnings growth is expected to bottom this quarter and then improve quite rapidly over the coming 4 quarters. This forecast will only be correct if core inflation moves quickly down towards 2%. If core inflation remains around 5%, then the Fed will have to put additional downward pressure on demand in the economy and ultimately earnings. That right there's the tug of war right now. Pick your battle. Pick your side.
Right. Well, we're going to see that. We'll see it today at 2 p.m. We've got a wonderful set of guests lined up. Thrilled to have Diane Swank joining us a bit later. Right now, on the festivities of yesterday from Miami to New Jersey, Emery Horton joins us, our Bloomberg appearance in federal court correspondent today. Emery, I'm going to go back with the language that we saw yesterday. I'm going to really try to make this apolitical. To a wonderful Philip Bump exercise in September in the Washington Post with lots of pie charts as he tried to figure out with his team at the Post, how big is MAGA out there? I mean, we got a massive dose of it yesterday, obviously. What are the centrist Republicans doing? Because the Philip Bump pie charts say that MAGA's really not that big as a general statement. What's the response to the non-MAGA conservatives in this nation?
Well, I think they're trying to figure out how they could potentially coalesce around another candidate. The issue, of course, is the concern for many of these centrists is that what you could see is what we had in 2016, which is a plurality, which is that even if MAGA is not that big, as you're talking about this pie chart, the issue is there's too many candidates sharing the remainder 70%, and the former president still has that grip on 30% of the party. Again, it is very early in this election cycle. There is more than 500 days until November. Potentially, there's rumors of other individuals getting in, the likes of the governor of Virginia, Glenn Youngkin, when their legislature elections are up more towards the fall. So this is what the centrists are talking about, and potentially the issue they see is that maybe the former president will have too many legal hurdles and he'll just start drowning in them. Of course, the flip side of that is that the former president used yesterday this massive legal hurdle. The first ever former or current president to be arrested in federal court. He used it as a campaign rally. What was shown after is that he made a stop at basically the Ben Chili Bowls of Miami, going to this Cuban restaurant where they were singing happy birthday, and it became an all-out campaign event. And this is where the former president really thrives.
His message, and it's always been his message way before 2016, is a message of grievance. Clearly, we all heard that yesterday, those that support the former president, those that do not. How is his message of grievance playing across the Republican spectrum right now?
Well, when you look at what the other nominees are saying, I would say that you're starting to hear a lot more noise about, as they thread this very fine line of making sure they do not ostracize these the base and the Trump voters. You are seeing a lot more of these, quote, serious concerns of this indictment. It's a serious case. You also had a new line from Nikki Haley, his former UN ambassador, when she served under Trump. Not only has she said this was reckless, she's now come out and said she would pardon the former president if she became president or the candidate and then president, because she thinks it would be good for the country. You have Vivek Ramaswamy, who also is a candidate. He's talking about and already said he would pardon the former president, but saying all need to make that case. Potentially, this is one way some see they could push Trump out of the race, but that will be the next and I think big litmus test over the coming months.
And Maria, I'm sure we'll cover this extensively over the weeks and months to come as it does evolve. I do want to just quickly get your take on something we were talking about a bit earlier in the program about the SPR and why we aren't refilling it at these rates. And sorry to throw you a curveball, but it's something we've been talking a lot about. We're at that $70 level. Why are we not hearing about material refilling of the Strategic Petroleum Reserve?
Well, I think at the moment they're still in the final legs of the drawdown. You cannot draw down and fill up at the same exact time. It's also a great question because the administration has said, though, around these levels they would. Potentially they see a little bit, or they could. I mean, I'm looking in a crystal ball here. Maybe they do see further weakness in the oil price and would prefer to wait if they drop maybe potentially closer to $60 a barrel.
Or they're just happy where prices are, AMH, and don't really care about refilling the SPR.
They could be. They could be happy where prices are right now and don't want to have this hurdle of spending some more money. But potentially they also could see some more weakness. I mean, what was pretty astonishing is after that last OPEC meeting where you had another unilateral cut from the kingdom, prices barely didn't even break $80 a barrel on Brent when you looked at the close of day. So that speaks to me potentially some more concern and demand. And obviously, when you look at demand, you have to look at China.
Brent right now, 75. AMH, thank you. Anne-Marie on the latest in Washington. Thanks to Lisa for bringing up the crude market as well. Just to recap some of the forecasts out there from JP Morgan. Cutting the 23 Brent crude forecast to $81 a barrel from 90. This follows Goldman Sachs and Jeff Curry doing the very same thing over the weekend, going from 95 to 86. That is their Brent forecast, Tom, going into year end. So we come down from triple digit and all that stuff, conversation from the 90s and now down towards the 80s with prices in the 70s.
You know, I've got on the coffee table at home, right next to the coffee table book, How to Raise a Happy Dog, the JP Morgan oil forecast for a year and a half ago, where Christian laid out and over $100 barrel pricing based on EM demand, based on just a global demand. We just heard from Amrita Sen the idea she believes the demand math is wrong, the market's taking it wrong, and demand's much better in a Christian Malik kind of way. And I'm fascinated here to see if we swing and get the demand that Amrita Sen perceives, or maybe Christian Malik sees, and we go beyond that 81 level, back out to 90 and back up we go.
This market enjoys making a fool out of people.
Oh, yeah. Oil's the worst. Yeah.
This oil market makes a fool out of a lot of people.
The only
Lisa,
one
that list is growing, isn't it?
It is. And so I feel like now that everyone throws in the towel, now we can see some real fireworks.
The only one I've ever seen always right about oil is Paul Sankey. He's never been wrong.
And when he's wrong, he admits he's wrong.
Yeah,
He's good at
he's
that.
never been wrong.
Oh, he's just never wrong.
Sankey's never been wrong.
He's never wrong. Is that what Paul told you?
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Equities right now positive 0.2%. 4-day winning streak on the S&P 500. Can we make that 5? Chairman Powell might be in control of the fate of that a little bit later on this afternoon.
Thank you for bringing this up. Did you see a chart in the last 24 hours in the zeitgeist of like after every Fed meeting, we go flat, 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 boring, 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 and then somewhere in question 42,
We've had some big moves to the
Smith
upside.
or,
Let's be clear about that.
you know,
We've had some big market days in those news conferences.
Yeah, but then Steve from the Death Star, they asked something and down we go. Am I right on it? Isn't that the summary?
You're saying that Mike helps the market go up and Steve makes the market go
No,
down.
it can go the other way. The next meeting can flip around, you know. But don't
trying
we
to cause trouble?
Don't we come out of this at 4 p.m. like, well, that was harsh?
Dazed and confused?
Yeah.
Dazed and confused?
I think so.
This one a little bit straightforward for some people at least. In the statement, they don't hike. This is the consensus view. They skip. They consider hiking again in the future depending on how the data comes in. And in the projections, the SEP, so it's called, the Summary of Economic Projections, they convey that there might be some work to do on interest rates. Right now on a 2-year, 467. The last time the Fed met, the 2-year closed at 380. Yields a whole lot higher. Yields a whole lot higher between the last meeting and this one. And in between, we've done a lot of work at the front end of the curve, and also in the FX market too. A turnaround in this FX market. It was all euro, 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 Europe, China, China, Europe, LVMH, Hermes, buy luxury, great Europe, euro dollar to 120, and it never got there. 110 down to 108, Lisa, this morning, and trying to rally as we talk about stimulus out of China.
Yeah, and as we talk about potential further rate hikes at the ECB later this week, even as there is a skip, pause, and hop from the Federal Reserve, this to me is going to be the key question. How much do they push back against the equity market exuberance at a time when there are some technological sea changes that people are trying to game out and say could fundamentally shift a lot of the growth in the U.S.? Tesla in the forefront of those, up about 2% in pre-market trading. This is the 14th consecutive session of gains, if it holds, for Tesla, which is a record streak.
Amazing.
After already adding $240 billion to its market capitalization during this.
Why?
This
unit sales?
No, this to me is actually truly a game changer if all of a sudden you have General Motors and Ford buying into their entire electric vehicle charging network and basically saying, you guys have it, we're going to adapt to you. This provides another leg to their business beyond just making cars. AMD also sort of getting fueled by the AI kind of trend, the other technological prowess that people are looking at. Those shares up about 3% after showing off its planned line of artificial intelligence processors. So still we are in the zone where AI is an immediate boom to stocks. And Shell, this to me might be one of the most interesting stories of the day. Shares up 2.5% in the ADRs after it increased its dividend by 15%, and they kind of moved away from emphasizing renewable energy and went back to emphasizing fossil fuels. And this is after the about face from BP. And now it's Shell basically adopting a U.S. model of saying, okay, maybe we went a little too far on this front.
A great exercise here. I'm a big believer in select companies reading what's called the MD&A, the Management Discussion and Analysis. And a great exercise, Lisa, is to go back 2 years, 4 years, 6 years, and read the MD&A at any company of what the vogue was at the time. The Shell MD&A from 6 years ago or 4 years ago or 2 years ago seems to be radically different than what you're messaging right now.
Well, and it's leading to this uncertainty. We talked about this yesterday, John, but this question around ESG and a sort of de-emphasis over the past 6 months by a lot of shareholders in particular, particularly with respect to oil companies who are saying, just cash in.
BP, Shell, what do they have in common? Lisa pointed it out, European players. Take a bucket of European energy stocks, compare them to a bucket of US energy stocks over the previous 2 years. Last year, clear outperformance for the US players. They got the PR story. They were too busy talking to their governments, not busy enough talking to their shareholders.
Yeah, and they get the trap of the big dividend. It's unnatural across all of finance to have that dividend that they've been paying. Do you perceive Royal Dutch Shell as a Dutch company or a London company?
A Dutch company that was headquartered in London.
I'm asking.
Historically.
Yeah, I don't know.
Yeah.
Okay.
Can I talk about Disney quickly?
Please.
I wanted to talk about this.
Michael Schumacher's like he's on the edge of his seat. Is this like Little Mermaid review?
When companies start throwing out dates like 2030, 2031.
It's Draghi-esque.
It's amazing. The third installment of Avatar is going to come out December 2025 instead of December 2024. Here we go, Tom. The 2 other Avatar sequels pushed back by 3 years. They'll come out in 2029 and 2031. Doesn't that feel like a lifetime away? 2031. Aren't we all going to be flying then?
Exactly. We'll all be
2031.
in augmented reality. Although, did you see The Way of Water? I mean, it was pretty technologically amazing.
It was very cool.
Right. So imagine that they have to then add on to that. But yeah, it seems like
Avengers movies delayed a year to May of 26, from May of 27. Star Wars pushed back a year, 2026. It's all getting pushed back. What's Bob Iger up to? What's he doing over at Disney? Can you imagine being in the theatre business and you hear this in the last 24 hours? You want those movies like now.
Well, is it the writer's strike? No, it's got to be something bigger like budgeting or just the complexity of it.
how much is content no longer king, and you don't necessarily have the same kind of budget to throw at it the same kind of way.
Michael Schumacher saying, did I sign up for this? Michael Schumacher joins us now, global head of macro strategy at Wells Fargo. We're not going to look for a Little Mermaid review from him. Michael, I want to talk about the challenge of Jerome Powell. And the way I do it is what Michael Rosenberg invented with his team at Bloomberg, which is the Bloomberg Financial Conditions Index. It is 11 ratios. It is so wonderfully complex. And it shows an accommodation. I'm not going to go to the math now, folks, but all you got to know is a positive number is accommodative and a negative is a tilt towards restriction. Is the stock market hindering Jerome Powell's choice set, his degrees of freedom? If we become accommodative, is seen by the BFCI at, I think it's a 0.079, that he has fewer choices that he can make, fewer options that he can make today.
Sure. It's a tightening cycle. That means conditions are supposed to tighten. And you look at the stock market up, 13% really since March. Granted, I know regional banks, et cetera, bad news, but still, equities have ripped. Corporate credit's doing really well. This flies in the face of banking credit conditions tightening. That doesn't really seem to add up. So I think Jerome Powell, you're right, Tom, he's got less flexibility.
Yes.
He somehow has to convey to the market, this is bad, but how does he do that? Tough.
The only way he can do it, Mike Schumacher, based on my reading history, is to delay, pretend and delay. So we're going to go through today. He's going to read all sorts of statements that are going to be, the answers are going to be written out in advance. Is this a meeting in preparation for July, hoping the facts change for Jerome Powell?
Well, they could change. The one big thing between now and the July meeting, granted, the economic data flow pretty light, but you think about regional bank earnings, they start to report the regionals. This is, I think July 19th is the first big day. The next Fed meeting is the 26th. So it's possible you get lots of noise, let's say in the week or so ahead of the July meeting, but that seems like a long time away. I mean, heck, if Disney is delaying Star Wars 3 years, maybe the Fed can look out 6-7 weeks into the future, but that seems like a stretch.
Especially because perhaps their budget is a little bit less than the Avatar sequels. I am curious, Mike, how much we
Just
have...
a little, yes.
Just a little. We've priced out rate cuts. That's what we've been doing over the past couple of months since the rate cuts priced in during the banking crisis that happened for a half a second in March. I'm now wondering, do you expect the market to start pricing in materially higher rates as one person after another on surveillance this morning have come out and said there is more work to do and the dynamism of this economy is not going to crack under 5% rates?
We think, Lisa, it's really been interesting. You make a great point. When you look at the degree to which rate cuts have been priced out for 2023, it's amazing. So early May, there was something like 90 basis points in cuts priced for this year. Now it's 15 or 20, give or take. If I look at 2024, it's about 130 basis points in cuts. We think that number goes down. Does it go to zero? No. Maybe it goes to 100, something like that. So a decent amount of rate cutting taken out. What I continue to be surprised by is why the markets are pricing so much easing by the Fed relative to other central banks. We're talking again about next year. Or you can even look at it this year, the relative policy paths. Why is the ECB priced to hike 55 basis points between now and September, and the Fed is priced for 20? And why does the market price the Fed to be effectively unchanged at the end of the year when other central banks are priced to be much higher? That makes very little sense to us. We think the market's got that wrong.
Well, perhaps they've got that wrong, but based on what people are expecting from the Fed, they're only going to confirm that if they're going to skip, no? I mean, will that necessarily feed into some of the optimism and, as we were hearing earlier from Bruce Kasman, the exuberance in risk markets?
Yeah, the action today, Lisa, I would say is going to be all in the press conference and not in the statement. If you look at really the period of the last year, so go through the last 8 Fed meetings, very, very consistently, whatever the market does during what we would call the statement period, so call it 2 o'clock to 2:25 or what have you, goes into a U-turn once Chairman Powell takes the mic. So he walks back some of the policy moves, tries to explain a bit, tries to amplify, maybe talks about delaying, whatever it might be. The
Gets
market
confused.
says, oops, we got that a bit wrong. Let's go the other way. We're confused. So I think you'll get more of that today. So look at the press conference and focus less on the statement. That's my recommendation.
And looking forward to it. Great recommendation as well. Mike Schumacher of Wells Fargo. Mike, thank you for that. Looking forward to that in a big, big way. Got to talk about the UK as well. Something I'm hesitant to do a lot of the time. But just looking at what happened with the gilt market more recently, we're back to about 482. Yields are higher than they were at the height of the Liz Truss quasi-quarantine crisis, if you want to call it that. Had all of this drama about what would happen at the Bank of England, what wouldn't happen. And we're talking about the prospect of 6% interest rates at the BOE.
Yeah.
So let's think about what we've been getting wrong over the last 12 months. We thought that if you went to 5, economies would crack. The US, the UK, Europe, we thought they'd struggle to get through 2. And we're talking about 3, maybe even 4. So we got that wrong. And then we looked at some central banks elsewhere that had paused, started to communicate a conditional pause, and we thought they were done. Then they restarted. So we got that wrong. And now you're hearing from Mike Schumacher there of Wells, and I think this is really, really important stuff. The US is showing more resilience than perhaps other places worldwide, and yet we believe they're going to cut more than everywhere else. What's that about?
We still believe in the lag effects that have not transpired to the degree that they were supposed to. And this really is going to be the tension for the Federal Reserve. Do they still believe in the lag effects? Do they still believe in a fragility that is anything but what we're seeing in risk assets and anything but what we're seeing in labor markets? And that, to me, is the distinction between the U.S., which got ahead of some of the other central banks and started before them.
The FX market's different to the end of September, that's for sure. If you think about the gilt crisis at the end of September, 2 days from the peak in the 2-year yield, 2 days before that, cable bottomed at 103.50. Cable right now is around 125, so we haven't got this sterling issue. And there is a big difference. I think a lot of people are asking why. Why haven't we got that sterling weakness when we've got these yields higher and there's all this panic about the central bank? This is coming so far without financial instability. It's coming without the risk of policymakers making it worse through fiscal policy. Still an inflation problem. And it's coming with the full belief that the Bank of England is going to have to do something about it and can do something about it by hiking interest rates. And that's the difference, I think, between now and what took place in September.
The key thing today is the 6%. Are we beginning to frame something I hear very few people talking about, which is moving from the 5-ish short term? No one can imagine getting up to that 6% level that you mentioned.
From New York City, if you're just tuning into the program, welcome to the program. Good morning to you. Equity futures this morning on the S&P 500 positive by around about 0.1%. Coming up very shortly, David Bailyn of Citi Global Wealth, Mike Wilson of Morgan Stanley, Jonathan Pingle of UBS. David Bailyn of Citi with this to say on the equity market: highly concentrated US tech rally, masking the value still embedded in global equities following the 2022 bear market. Not the first time I've heard that this week, TK. And it's not going to be the last, because we're going to catch up with him in just a moment.
A lot of respect for David Bailyn, and the basic idea here is you have to participate in the market. Where? I mean, there's a whole group of people saying, I'm in cash, I'm comfortable, I'm out of the market, when do I get back in? And that, and what a lot of people like David Bailyn are saying is you got to be in the market, so, okay, where? I mean, exactly how much NVIDIA can anyone own?
I love that we're starting a new bull market, evidently, with all these people expecting the broadening out right ahead of a Fed that is talking about the need to really bring down inflation and a labor market. And this is the collision course that perhaps is the most underrated collision course of all year, because people have stopped talking about it. They're just like, AI, it's going to mask everything. It's going to be great.
Well, it has done so far, hasn't it?
And now everything's great.
Let's see how keen they are, how committed they are to getting inflation back down to 2%. Do they go down the PIMCO route, which is tolerate 2 point something? And if they do, and they can support growth, then we've got a different story, haven't we?
They'll deny that the whole way. It's just a canon is 2%, but if they get there, fine.
That's the hope and a prayer of an equity market bull right now. Equity futures positive 0.1%.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence. for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture down. The BOK is getting ready to make.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Hard to talk about a skip. It's possible, but it's not our view. I think the Fed has 6 weeks to the next meeting. If it is actually trying to take stock of what actually is happening in terms of banking sector stress, monetary transmission, it's going to take more time to see that. But at the same time, I think they have to tell us that they have not declared victory on getting inflation down, that there is pressure for them to move more.
That's Bruce Kasman there, the chief economist over at JP Morgan, weighing in on the Federal Reserve, looking for a pause a little bit later. A divided one, though, where the committee ultimately votes not to hike interest rates. But some people on the committee say, you know what, I think maybe we should be hiking interest rates, which sets the stage for a bigger debate maybe down the road in July when they get a little bit more information and can make another call. Ultimately, they don't want to communicate just yet. Consensus view, they don't want to communicate just yet that this hiking cycle is over after starting it in March of last year.
But will he communicate it in the press conference? It'll be fascinating to see how he plays that.
The delicate dance of communication in the news conference coming up a little bit later.
And then frankly, Lagarde right after it is probably just as interesting.
Tomorrow, yeah.
We aim to please here, and what we do quickly before we go to Applejohn is to actually go back and look at an annual report. We're talking about Shell, Royal Dutch, is it Royal Dutch Shell? I always say Royal Dutch Shell, like I say British Petroleum, and I get emails.
I think RDSA is the ticker, isn't it?
Yeah, whatever, we'll go with that. 2019, this is published, I believe, in 2020, but this is before the pandemic, let's say, to be fair. The chief executive officer of Shell. When I look at Shell, I see people with high hopes and social commitment. We wholeheartedly support the goal of the Paris Agreement. And of course,
well, that was the old CEO, right?
The old CEO. But again, in full disclosure, Bloomberg surveillance and all of Bloomberg has been very much involved with the Paris Agreement. We were there for it. But that's what Javier Blas is writing about today, is, boy, have things changed in oil.
Yeah, the new guy doesn't sound like the old guy.
I guess so, and it's some level of black is what they're going for.
It's also a reality check as well.
Yeah.
All the happy talk about transitioning away from some of this stuff is tremendously difficult and slightly misleading for a lot of people as well. Can I get you some news out of Google too?
Please.
Here's a drinking game. How many times have you seen this headline, drink? Google accused of abusing its dominance over advertising technology to crush competition. This from guess who? The European Union. Vestager, the EU Competition Commissioner, saying Google is present at almost all levels of the so-called ad tech supply chain. Our preliminary concern is that Google may have used its market position to favor its own intermediation services. Hasn't this been a concern for like
huge cultural,
forever?
Cultural.
Well, you know how people feel about this, so let's address the elephant in the room. There is a belief in the United States, held by a lot of people, that Europe's harsh on these tech firms because they are not European firms.
Maybe.
Europe doesn't have them. Doesn't have Alphabet.
They're harsh about the scope and scale of them, whether it's Apple or Google or the others. It's the mass
Can I just say, it really tells you how much people care. Alphabet shares, Google shares down about 0.2%. That's a big yawn. No one cares.
Let's get to a
One day it might matter, but let someone else decide that, Tom.
Let's get to a $3 trillion question. We do that with Tom Forte, expert at senior research analysis at D.A. Davidson. He got an Atari playset years ago, and now he's turned it into a Mac Pro and a study of Apple. Tom, we need an update here on the vector of Apple up 40% off the January beginning of the year. There's a persistency to the trend. What's your target as the trend continues? Do they blow through a $3 trillion valuation?
Yeah, so maybe the word of the day is pause. So I think Apple shares are going to take a pause here. I think the good news from the new product launch, the Vision Pro, which is the most significant new product launch since the iPhone in 2007, is priced into the stock. The stock's trading at a premium on an enterprise value to EBITDA basis, on a PE basis, and on a sales to EBITDA basis. So I think the good news is priced into the stock. I'm looking for shares to take a breather.
The core unit thing is the iPhone. I believe there's a new iPhone language coming out, maybe a new iPhone chip. Can they keep innovating the iPhone to keep the unit sale persistency going?
The answer is yes. But on a near-term basis, what does success look like for Apple? And it looks like low single-digit sales growth, definitely not double-digit sales growth. So you have a stock trading at a premium multiple relative to its history. The iPhone's doing amazingly well in a challenging macroeconomic environment, taking advantage of the networks, leveraging their 5G networks, Verizon and such, and helping consumers buy the phones, subsidizing them, Apple offering buy now, pay later, all these different things. So yes, iPhone can carry the day, but I think a lot of this good news is already priced into the stock.
Tom, will Apple use artificial intelligence and chat GPT type of technology to make Siri better and to make it a more sort of intertwined aspect of the iPhone?
The answer is yes. And I think that when we started the discussion of artificial intelligence, so I've published 25 papers on the convergence of tech and retail. One a couple years back was on the power of artificial intelligence. Apple, I think, appropriately discussed that it was a horizontal technology, not a vertical one. It makes all of its products better. Hopefully it'll make Siri better.
We're also talking about augmented reality, and you talked about the Vision Pro, the $3,500 goggles that people can put on and experience a new and improved world. What is the future of this? Is this the future of computing? Everyone talks about how this is revolutionizing things in a way that the iPhone did, but we're not really understanding the implications. Can you give us the sort of market case, who wins and who loses?
So I'd like to think about it in the view of the metaverse. And our view is the metaverse will be a thing, not the thing. So 10 years from now, consumers will be accessing the internet in many different ways. They could have implanted chips, which is something Elon Musk is working on. AR, VR will be one of many ways that consumers will access the internet, but we don't think it'll be the dominant way. I do think the winner on the $34.99 Vision Pro is Meta Platforms, which is offering a device for $499. So to the extent that Apple gets people excited about AR, VR, I think Meta Platforms stands to benefit with a much lower price point item.
We had on Abby Joseph Cohen from Columbia University, formerly a partner of Goldman Sachs, yesterday, and she said she's been talking to computer scientists, and her sense is that perhaps people are overly optimistic about the future of artificial intelligence and what some of these chat GPT technologies can actually achieve reliably. Do you agree with that? Do you feel like it's been sort of overplayed, at least to this point?
So my concern about it is as a consumer who grew up with Skynet, but my primary concern is what happens to all the displaced workers if we truly become a fully automated or much more automated society. So what's going to happen to the economy if 25% of the workforce is displaced by automation? So yes, I think that there's way too much hype on what it can mean. I simply think of machine learning as the ability to decipher what is a cat, what is a dog, things of that nature. I think the chat for customer service is flawed. It may always be flawed. A chat for search has elements that are flawed. It may always be flawed. So I think artificial intelligence is a very important technology used responsibly, but I think there's going to be a lot of challenges, including an increase in automation and a displaced workforce.
$34.99 makes it sound cheap. $34.99. $3,500, Tom. How are people going to pay for this?
3.5 large. How about that, John?
It's huge.
So basically, if you look backwards, we could see why Apple's done the credit card, buy now, pay later, things of that nature. I'm of the belief in the future, Apple will offer you a pure subscription. For $250 a month, you get Apple. What does that mean? You might get a Vision Pro headset. You might get the latest iPhone. And then if you're paying $250 a month or whatever it is monthly, you may not think about the $2,000 you're paying for the iPhone, the 3.5K you're paying for the Vision Pro. So Apple, as a monthly bill, it'll be a big bill, but then I think it'll be easier for them to sell some of these higher priced products.
Tom, I've got to squeeze it in. That's been developing with the headset already. What does that mean for the valuation of the company as you start to get more recurring revenue in that fashion?
Well, it meant a higher multiple. So the beauty of Tim Cook's leadership has been the higher multiple he's achieved by adding services to a strong base of hardware. The question is, will they be able to complement future hardware and services offerings to massively increase the sales base and then on a higher multiple increase the stock? And right now we're taking a wait and see attitude.
Bingo. Tom, thank you. Tom Forde of D.A. Davidson at the end there. People have been talking about this for a while, Tom. I think I had that conversation with you 7, 8 years ago about hardware as a service, recurring revenue. Then you start to spit that kind of money off and you get a better valuation.
I'm going to go Peter Lynch 101. Walk wherever you walk, dine, live, whatever. How much Apple product was in your eyesight? You're walking down the street. How many people are glued to their Apple iPhone as a physical entity? They've been able to maintain margins, even with the single-digit revenue growth. And I just looked up the COVID cash flow from pre-COVID. They've gone from $58 billion to $100 billion in free cash flow. That's just...
What's the family subscription going to be, Tom, for the headsets?
Oh, don't get me going.
The AirPods.
$34.99. That's $3,499. Yes.
A month. Equities up. Mike Wilson, Morgan Stanley. Coming up in about 10 minutes.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid
work model. Do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
We're selling rallies and buying dips.
There are investment opportunities to be made, to be identified in the context of growth slowing down.
Ultimately, the next couple of years are likely to be good for equities.
The US has got an inflation challenge. I don't think the fight is over.
Inflation is coming down. It takes pressure off of the Fed to continue to raise interest rates.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Fed Day, our coverage at 2 p.m. We're going to start at 1:30 this afternoon. There's so much to talk about, but spirited conversation in this hour. And if you are in or not in the stock market, stay tuned. David Balin to be with us here in a moment with Citigroup. He's nailed participation in the market is necessary. Somebody brought it up, you, John, Lisa, earlier, and it's real simple. It's a bull market. Does it matter to Jerome Powell?
Skip, pause. It's not the end. That's what they want to communicate today, according to so many people. They might take a pass on hiking interest rates at this meeting after hiking interest rates for 10 consecutive meetings over at the Federal Reserve. Numbers matter. March 16th, the Federal Reserve hikes for the first time in this cycle, March 16th of 2022. The S&P 500 closing that day at 43.57. Closed yesterday, 500 basis points later, three bank failures. All this conversation, talk about recession, closed yesterday at 43.69.
And what's fascinating is, the Fed is like a great marriage, folks. We got to be focused on this. I mean, the fact is, a great marriage has no dissent. And, John, we've got no dissent at the Fed today.
You might get some dissent a little bit later, and potentially from Fed presidents, but maybe from a Fed governor too. We haven't had a Fed governor dissent, and thank you for the team here at Bloomberg for coming up with this stat, since 2005. 2005, right. TK, it's been that long. Will Chairman Powell welcome some dissent today, just to communicate to people that there are some people on the committee that would like to hire?
Literally, where he goes to people, I agree. He will literally go to them and say, if you want to do it, this is the time. Lisa, your observation here on, again, futures up 6. There's a terrific bid to the market. NASDAQ up 0.2%. And you mentioned earlier all the gloom about real estate and banks. Bonds do well on a spread basis.
And you are seeing this rally persist. I just want to bring you this. Andrew Hollenhorst of Citigroup, who's been pretty consistent saying that the Fed will probably hike at 25 basis points, put out a note basically saying, okay, they might skip, but it's the wrong decision. It means they are not data dependent. And he writes, a quote, surprise Fed rate hike has not been seen since the 1990s, but the biggest Fed policy surprise in 30 years might be appropriate given the highest inflation in 40 years. And this is the tension right now in markets.
Well, that's what we see here. And of course, there can be events that make us more optimistic. Is this an optimistic event at this moment, John?
Here's a headline from the U.S. State Department. Secretary Blinken to visit China and the UK, June 16th to June 21st. So get that in the diary. June 16th to June 21st, Secretary Blinken to visit China and the United Kingdom.
You wonder, that's an interesting combination there. You wonder which meeting will be more stressful.
I imagine based on recent events, it's going to be China. Bear in mind that he was set to go to China, and then we had the secret spy balloon, which was not so much of a secret since we all saw it flying through the air, and China said it wasn't a spy balloon. They said it was the weather. And the administration confirming it was a spy balloon.
A lot more complexity.
The issue is, and the issue I had with the situation at the time, is that it wasn't the first time a spy balloon flew across the United States from China. Except this was the first time we all found out about it, and Secretary Blinken was going anyway. So he had to cancel his appearance in China because we'd all seen it.
Right.
And now he's going anyway, which is hardly a shocker, is it? Because he was going to go anyway, knowing that these things were happening. So, like, you know, it's just one of those ridiculous things where sometimes you're managing foreign policy for domestic PR purposes, TK, and I think that was a great example in the last couple of months.
No, domestic quiet is a good and beautiful thing. Let's do a truncated data checks. John, stocks are up.
Stocks are up and have been for the previous 4 days. Can we make it 5? On the S&P 500, up by 0.1%. Going into the Fed a little bit later, the dollar weaker, yields just a touch lower. The 10-year, 380.95.
An important conversation now for Global Wall Street to reset to the mid-year. David Balin joins us, Chief Investment Officer, Head of Investments, charge of the bull market at Citi Global Wealth. Your creed, David, is you have to participate. You have to be in the market. Speak to people now who missed this leg from October. Speak to people who are comfortable in cash.
Well, if you're comfortable in cash, then you've really missed the whole message about what's going to happen in 23, 24, 25, when we're going to go back into a higher growth mode, having come through what is now a rolling recession. And it's very tempting to leave your money, in cash at 5.25%. Or in a money market fund, and then take a look at that return this year versus what's happened in the market, right? You've probably made 2% in your money market fund so far, but you would have made between 6 and 11% in a normal portfolio. And when no one can predict what markets are going to do, you don't want to be out of those markets. That's why you have a core investment portfolio, and then you can trade opportunistically around it. This has been the case of that. No one would have predicted this market doing what it's done for the last 2 months. But I think it's clear now that market timing is a very bad idea.
Well, at this point, people are wondering how much the Fed's going to care about the exuberance that some people see in certain stocks, and maybe that will start to broaden out and has already. How much do you see the rally as being really susceptible to a shock from a Fed that may not be done that might actually go quite a bit more?
Well, you have all done here, right, and everyone media-wise has made it very clear that we were going to have a recession. It's so been well telegraphed, and the discussion around what the Fed's going to do has been wildly...
Are we blaming the media?
I'm not blaming. No, it's not a question of blaming. It's not a question of blaming. It's that we've telegraphed what's going to happen. We've been discussing hike or not hike, right? And the truth is that what's going on now, right, and this is partly, what's happened with AI, but partly what's happening in that some industries are shrinking, some industries are growing, right? And that inventories are coming down, and we're having the recession even as we're having other parts of the economy grow. And that's what led us to think that when we get to 24, we're going to be a greater growth environment with earnings in general going up. The market, you can begin to see it broadening now, right? First, it was just 5 stocks, 7 stocks, 10 stocks. Now you're seeing the S&P 400, the S&P 600 moving up. And that, to me, is an indication of the broadening that's indicative of what's going to happen in 2024.
This implies that we've seen the bottoms. And with respect to earnings, with respect to any sort of downturn that might have percolated into a revolving rotation of sectors. How much does the Fed kind of kill this, right? I mean, we were talking earlier about the collision course of the Fed versus the markets and versus the fact that inflation is not coming down as quickly as they think. Do you see this as compatible, or is this a collision course it's going to have to resolve in a messy way?
Well, the collision course is really what the Fed wants to do, right? Which is it wants to lower inflation, which has gone, by the way, from 9% all the way down to 4%, right? So it's already coming down. We have, now we have rents rolling over, right? And really what the Fed's last stand is going to be is about wages, right? That's what they're going to focus on. And so I do think that they're going to cause us to have unemployment finally at the end of all of this, which is, the recessionary sign that we're looking for. It's taken a very long time to get there. The market has been very resilient, right? So I don't think that these are incompatible, right? I think we're going to have earnings rise in 24. I think we're going to have slightly higher unemployment. We're going to have a very shallow recession, and that's what's going to happen.
Portfolio 101, this is a Peter Lynch phrase I'm stealing. Is diversification your enemy right now? Should you have a more focused portfolio or utilize diversification?
Tom, this is the sort of market for diversification. You want to have a great bond portfolio, right? You can extend your duration, extend your yield, and that will then serve as a cushion when equities go down, which is what it's supposed to do. You want to be entering new parts of the market, non-U.S. stocks, small and medium-sized stocks, the smaller parts of the growth market in the United States. You want to get exposure to Asia if you believe the dollar is going to fall. All of these on a relative value basis are better than owning the S&P. But the total market value, right, of doing that, right, is at the end of the day a stronger, more resilient portfolio.
I'll take the phrase to go to the total value of the S&P, or John, the Dow Jones Industrial Average. But far more, our audience is not looking at that. They want to know, should they load the boat on Apple and its brethren?
Well, I mean, I think that that result is sort of behind us, right? These stocks are very fully valued on on many different bases. But the stocks, the next group of trillion-dollar companies, the next companies going from 100 to 200 billion, are right there, and they're going to be much broader set of companies that are going to be impacted by the efficiency associated with what AI actually does. It's going to take years for that to happen, but you can begin to project it across industries, that employ white collar workers, low and medium wage workers, where there's going to be real value added to those companies.
John, I didn't know this. Apple, 31 multiple. That's how it's rushed away. I thought it was a 24, 25.
UBS cut to neutral this week based on some of that.
Wow.
Based on some of that.
Just stunning.
Dave, and I always roll my eyes when people say things like the media and recession. It drives me insane. I'm a sensitive guy. I'm emotional.
I wasn't faulting the media, but the government has gone out and talked about the recession so far in advance that people began to plan for it. They began to reduce their capex. They began to rationalize when they were going to spend money. They knew it was going to come, and they've actually been able to hang on to higher prices. Many companies, even planning for that.
If you mean, does the media shine a light on bad calls from economists on Wall Street? I totally agree.
Right, and CIOs too.
I'm guilty of it every single day. Every single day. David Baden, I'd never say that about CIOs. They're brilliant.
That's okay.
They're City Global
They
Wealth.
have them. They don't make
Sharp
mistakes.
today. No, look, it's
We just
been tough.
cataloged them, yeah.
Look, just because people got the recession call wrong doesn't mean that it will always be wrong. And this is the reason why I think this market is saying they're sick of talking about recession. Doesn't mean it goes away as a risk.
It's been this 12-month rolling forecast. It's 3 months away. It's 3 months away.
Well.
It's always 3 months away.
Yeah,
it's like next quarter.
Yeah,
deal with it.
Jamie Dimon,
next
5
quarter.
years.
Jamie Dimon, it's always 5 years.
Yeah, there you go.
It's that about Jamie Dimon. It's always 5 years. He's asked, you ready to go? It's like 5 years.
Yeah,
5 years.
I would go with that.
I used to play this game with Ivan Glassenberg at Glencore, and it was like he'd do the same thing. It'd be like 5 years, and ultimately someone else decides in the end.
Well,
he keeps saying 5
Balin
years.
has lifetime tenure, but seriously, you wonder, not to make a joke about it, but the people that have been bearish, when do they change their tune? I mean, what is the mechanism to escape from a bearish call?
So we've mentioned JP Morgan. I think that's the conversation that I'll be having with Bob Michael in the next hour. This cash trap that we've been discussing, it was so attractive at the start of the year. Finally, right? Cash wasn't trash, 4 or 5%. Let's go. Great. Then stocks just ripped, and you're sitting there mid-year after being in cash all year, and you're thinking, 1-800-DAVID-BADEN, I need to put some money to work in the equity market, and that's why this conversation about an equity market broadening out. It's where it's coming from. Because it sucked the capital away from money market funds.
I've gone back to the analog of 75 up to 76, and then a second leg up from there. I'm not saying it's going to happen, but that's the constructive debate into July.
To quickly answer your question, how do you move away from a bearish view? AI. It changes everything. I'm going all in.
Done. I'll say this about...
Put on the thing.
One last word on money market funds. Just remember that a lot of people in fixed income have an incentive to tell you can make better money elsewhere, because the fees on that stuff, not great. You can attract all the capital in the world into your money market funds. You need to get that money to go somewhere else. That's my word on that. From New York City, if you're just tuning into the program, welcome to the program. Equity futures this morning on the S&P 500 positive by 0.1%. Coming up in the next hour, Bob Michael of JP Morgan alongside Greg Peters of PGIM, Victoria Fernandez of Crossmark, all of that taking place going into the Fed meeting a little bit later on this afternoon. Hike, skip, a pause, Bramo. I think we're all on the same page at the moment. The consensus view is that they skip and take a pass later this afternoon.
The question now moves on to, are they done? And it also moves on to, okay, we've priced out rate cuts. How much more do they have to do if the long and variable lags are not necessarily as significant as people previously thought? And I think that really is the new conversation. Markets have moved on from the banking crisis. I don't know that the Fed has yet.
Yeah.
And when they do, how much does that shift the rate discussion?
Such a great point. And we still haven't answered this question.
You never say to me it's a great point.
Well, because sometimes it's not.
Okay, thank you.
The long and variable lags, just how long are they? Are they like super long, 30 years long, because rates are locked in and everyone's got those? I say everyone.
Should we have a drinking
I want
game?
one of those 30-year
Yeah, exactly.
mortgages at
Plus
3%.
or minus 3 minutes, should we have a drinking game in a press conference today of when the
What will it
chairman
be?
mentions
Skip?
long and variable
Long and
legs?
variable? Maybe.
Could make it fun.
Maybe. Look out for Mike Wilson with his bear case on equities and earnings in just a moment. Looking forward to that conversation. It is about 3 or 4 minutes away. From New York City, equities higher on the S&P, positive by 0.1%. This is Bloomberg.
markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From the wizards and capitals to new ventures and innovative investment, running a sports empire in Washington, D.C. is a monumental task. Horner Ted Leonsis trusts CFO Peter Bichet to execute monumental sports and entertainment's financial game plan.
We are definitely in growth mode. What else can we do? How do we grow the platform?
Watch Chief Future Officer today on Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Today, will the Fed pause or hike?
The steepest tightening cycle since the 1980s may be about over.
It's a we've never been here moment.
And where will they go from there?
They may leave the door open to additional rate hikes.
They say pause and this market hears cuts.
Trust Bloomberg for the fastest coverage and exclusive analysis.
What could potentially torpedo this?
You're not really seeing the slowing in the labor market.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
At the beginning of the year, we called for recession coming, and we called for persistent inflation. We're going to see evidence of that very, very soon. Recession is, is coming, but maybe already here, right? But the bottom line is there are investment opportunities to be made, to be identified in the context of growth slowing down.
Whaley of BlackRock there with a key phrase, persistent inflation. That's where we're going to go right now. Lisa Bramowitz and Tom Keene with you here as we move to a Fed meeting. 2 p.m. this afternoon, we'll have special coverage for you. I want to revisit here before we go all equity all the time, Lisa, the bond market in the disbelief, forget about persistent rates, but the vicinity is mentioned in the United Kingdom today of the dreaded word 6, of getting from 5-point excess on short paper. No one's modeling that it could go to 5.5 or 5.6 or even touch a 6 handle.
March 1st of this year, people were talking about the potential for 6% rates. Now they're not because banking crisis, and yet everyone's moved on from banking crisis and moved into some of these regional bank stocks. So at what point does the Fed either lean into banking crisis, credit contraction, some sort of significant lag, versus this feeling perhaps we need to revisit the belief in that dreaded 6 handle or potentially much more restrictive rates?
Something to worry about. And if you want to worry, you can look at a bull market effort right now. We're seeing many houses adjust higher. At the Morgan Stanley shop, they are not. Michael Wilson is CIO, Chief U.S. Equity Strategist at Morgan Stanley. And one of your themes, Mike Wilson, is there's a complete misguess on the interstate game as addressed by the Fed today and followed by your Ellen Zentner. Whaley there of BlackRock says persistent inflation. Is that a core reason for your caution in the equity market?
No, it's actually not, Tom. In fact, our view is that inflation is going to come down, and while that potentially is very good for bonds, it's not going to be good for stocks because that's where the earnings power has been coming from, right? This is really our boom-bust thesis. The reason we were so bullish in 2020 and 2021 is because we expected inflation to drive a profits boom. And now when inflation comes down, you're going to have a profits recession. So that's really where we're differentiated from an equity standpoint. Ellen, as you know, is looking for a pause today too. She's not looking for, any more hikes really the rest of this year, but a very slow path in terms of cutting next year.
What are you looking at going forward in terms of client responses, how they push back against the bearishness that you've been expressing?
Yeah, look, we're in a weird situation now because I feel like on the fundamental side, our earnings call has been spot on. So a year ago, just to kind of remind listeners, we were calling for an earnings recession and we were somewhat dismissed. But of course, now we're in one. And the only difference now is that we're just saying it's going to persist. Whereas I think most people, the pushback is, no, the earnings recession is over. And we're going to see a reacceleration in growth in the second half of the year. And that's what the consensus is forecasting. So that's what the pushback is.
So in other words, you're saying that you got it right if you strip out some of the big tech names and that there was an earnings recession that played out in lower valuations of some of these shares. And you're saying it's going to continue, not necessarily talking about the headline level of the S&P as much as these particular stocks fighting against the idea of a broadening out of the AI rally. Is that correct?
Well, actually, the technology stocks had the biggest earnings recession. I mean, you look at the communication services and some of the technology stocks, their earnings were down significantly in the fourth quarter. That's why they sold off so sharply in the fourth quarter. So they had an earnings recession last year, and the presumption is that's over. And now that's going to reaccelerate. And that's where we disagree. We think that including tech, not just tech, but overall the earnings recession is going to persist into the second half of the year. It's going to get worse before it actually improves next year.
If we get a Zentner economy or Ed Hyman moving down to 3%, dare I say under 3% inflation, David Rosenberg up in Toronto clearly in that camp as well. I'm thinking of the partial differentials on the income statement to get to the Wilson earnings call to get to 3,900 or whatever on SPX. And to me, it's all at the revenue line. And that is the core of your call with your security analysts that revenue growth will disappoint.
That's exactly right. So last year, the earnings recession I just referred to was all a cost issue, right? These big tech companies overinvested, thinking the pandemic boom was going to continue at the same pace. Of course, it did not. And that was a problem for discretionary, consumer discretionary, as well as some of the financial companies, et cetera, companies that overinvested. Now, what we're going to see is the top line disappointment. Okay, maybe it's not a recession, but like Ellen's forecast is 0% GDP growth effectively. That's going to feel like a recession because your pricing is going to evaporate. And we're seeing that now in goods. So there's this big dichotomy between goods inflation and services inflation. I mean, goods inflation is back to the 2% level. In fact, it's probably going to go deflationary for a lot of businesses. That's your revenue growth disappointing.
How do you allocate here? Do you participate in the market, or is cash a very comfortable place to be?
Both. So, and look,
that's a strategist answer, both.
Yeah, on one hand and the other hand, right? So take my economist hat. But look, I mean, in all seriousness, cash offers you a great risk-adjusted return. We're overweight cash. Okay, there's nothing wrong with that. But we still are fully invested in equities, too. We're just underweight our normal allocation. And we've been that way for the last 18, 24 months.
I think this is misunderstood, Lisa. I think people look at Wilson, they go, get out of the market. And this is a hugely important issue.
Every time he comes on, he says, I'm fully invested. It's not a matter of just simply hiding under a mattress. My question is, what happens if there's a recession and nobody cares? What happens if there's an earnings decline and people shrug it off and say, well, look to the future and there's going to be this incredible American exceptionalism, and where else are you going to put your money?
Well, this is our story for 24 and 25, right? This is why we're in a difficult situation right now, where we see the near-term risk reward is lousy. But if we look out 24, 25, this is what people are getting excited about. Capital boom for things like reshoring, green energy, traditional energy, retrofitting buildings, et cetera. And now, of course, AI. So this is exciting. The problem is it's a cost first, and then it's a productivity benefit.
Well, people are looking past it. I mean, this is sort of the frustration when people say that there's a divergence between bond markets and stock markets. They say, well, the bond market's looking at the now, it doesn't look very good, and stock markets are looking to 24, 25. What's to make them look at now, right? What's the catalyst to bring them down at a time when people can look past near-term pain and see what you're seeing?
Well, typically it's price. Okay, so we're very disciplined on price. We always get kind of categorized as a perma bear, but I remember calling the low in October. We called the low in March of 2020 because of price. So we're very disciplined. Most people are not disciplined because of FOMO. And that's just the nature of markets. Markets are momentum driven. It feels better when they're going up. It feels better to buy things when they're going up. And that's where we are now. So the risk reward in the short term is lousy. So I think it's going to be price, Lisa, which will change people's minds. Now, we could be wrong. Maybe we don't get a fatter pitch that we're hoping for. But we're also not worried it's going to run away from us. And we can buy the stock market kind of right here, probably 12 months from now.
What's the market bet right now? Because I see a lot of indicators that say people are comfortable with Mike Wilson's calls. They're really afraid of this bull market, and they're cautious. What is the bet that Morgan Stanley sees by the investment public, by the hedge funds, by long-only buy-side institutions?
Well, I think once again, our view is I'm in a position of luxury. I don't have to put capital to work every day for monthly performance. We have asset allocation, which is kind of measured on a longer-term basis. So I have the luxury of time, right? So our asset owner clients have that advantage. And that's what we try to take advantage of. Folks who don't have the advantage of time have to kind of participate at the worst possible moment. And that, by the way, it also includes at the lows, right? So the opportunity that was created in March of 2020 is because people were being forced to divest, and we were happy to pick up those shares at cheap prices.
What do you think is the most overpriced aspect of the S&P right now?
Well, I think this is an interesting question because most people assume it's only 10 stocks. That's actually not true. The median multiple for the S&P 500 today is the same as the market cap weighted multiple. It's close to 19 times, 18.5, 19 times. So it's a very broad overvaluation. Now, I would say the sectors that are cheap Okay, the only ones that are appearing cheap now are energy and financials. The question there, of course, is what are the earnings going to do? You know, because they're cyclical businesses.
Well, focus on energy there. You got 20 seconds of energy there. Is that the place to be?
Well, I think energy at the stock level, there's definitely opportunities, and in financials too, right? So like the regional banking crisis created opportunity in individual financial services stocks, and I think that's what we're trying to do now. We're trying to find these one-off opportunities as opposed to worried about the stock market overall.
Mike Wilson, thank you so much. With Morgan Stanley here with a call. 3,900 is where you are now. You want to make some news here?
3,900 year end, yes sir, we're still there.
Okay. You're going to let us know if you change any
Be the first call.
Mike Wilson, Morgan Stanley here. This is what it's about.
Q.
It's about a market of opinions, and it is extraordinary right now.
It is extraordinary, especially to parse through what the reality is. Is it just 10 stocks, or is it broader? What are the valuations that matter at a time when there is such a bifurcated kind of market?
You know, 19 is the multiple Mr. Wilson talked about, and I look at Walmart at 24 times and go, oh, really? Please stay with us. It is Fed Day, 1:30 this afternoon. We'll be with you.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Bloomberg Surveillance, Lisa Bramwitz and Tom Key. Thank you for joining us on radio, on television. Of course, a great partition here between the consumer price index and the PPI is with CPI, you've got two things to look at, core and top line, and with PPI, the great tradition is to look at three different items that have been amended over the years. There's only one person I know expert on CPI, PPI, and EIEIOI, and that is Michael McKee, that'll help us with business inflation right now. Mike?
Good morning, guys. Well, the EIEIO index is out. PPI final demand falls 0.3%, which is quite a drop for an index that was up 0.2 the month before. I'm sure waiting for the details to drop, but I'm sure that's probably energy related for the most part. The energy, the core rate, ex-energy, food, and trade comes in flat at 0.0%. That's down from a 0.2 gain, and both of those numbers are below what analysts had expected. The year-over-year final demand falls to 1.1%. Let me get you in a second historical on that. And the core falls to 2.8% for the year. So we are seeing a big drop in prices at the wholesale level. Now, of course, Tom, as you mentioned, they don't translate directly into consumer prices because the middleman gets in there and has some say about what things cost. But it is a sign that the lower level price from the bottom up prices are starting to fall backward, and it would just reinforce the Fed's idea that maybe they pause today.
It's interesting to see. I'm going to do the markets right now, Michael McKee, while you parse into many, many pages there. Lisa, help me out here. In the equity markets, there is a lift, but not all that much. I don't want to overplay that. In the bond market, it's a boom moment. The 2-year yield comes in, slams in nicely. 30-year bond even comes in again. But what I've really got here is a readjustment on the 10-year tips from a 1.60 down nicely to a 1.57 handle, and currencies really move.
Yeah, I'm looking right now at the euro versus the dollar, and you could see it pop on the heels of this. Basically, this belief that the ECB on Thursday is going to raise rates, and this just reconfirms the idea that the Fed is not going to move today, and potentially that this disinflation will gain steam as time goes on, which I think a lot of people in the equity markets seem to kind of be holding on to.
The DXY index, there's two dollar indexes. DXY, the traditional index, which is very euro-weighted, 54%, I believe, euro, and that slams down as you see that strong euro, and even Bloomberg Dollar Index moves as well. The Bloomberg Financial Conditions Index moves to a more accommodative stance. I mean, this is, I guess, to script. And as John Farrell mentioned earlier, Lisa, you wonder if this is where Powell begs for dissent today to make it truly asymmetric versus makes it symmetric versus an asymmetric certitude about rate cuts to come.
Yeah, here's the issue, though. This is in the goods sector. We knew that there was disinflation in the goods sector driven by energy. Services in the labor market really has driven the other side of it. So how much are they going to really emphasize the need to see some more disinflation on that front beyond anything you see in the goods sector?
Michael McKee, looking at the various stages of wholesale business pricing. Mike, it used to be easy. There was like the beginning of the factory, the middle of the factory, and final demand, what came out the door. You've lectured me, it's more complex today. Which part of PPI has your attention?
Well, Tom, we generally like to look at PPI for final demand, trade services and energy and food, because that's essentially a core rate. The trade services is not trade in the international sense. It's basically the margins received by wholesalers and retailers. So you get a picture there of what's going on at a lot of companies. Now, the decline in the overall final demand number was, as I said, due to energy prices. Gasoline prices down 13.8%. Energy prices in general down 6.8%. Food was down 1.3%. Remember when food was a big part of the CPI, so we may be seeing some benefits there. Services moved up 0.2%, but that's down from a 0.3 the prior month, so maybe service prices are starting to come off a little bit. And I'll leave you with one interesting number here. An index for iron and steel scrap fell during the month. Remember when Alan Greenspan was chairman of the Federal Reserve, he used to look at steel scrap as an indicator of how the economy was doing. It's where you sell your old
Right.
refrigerator or your stove. They melt the steel down and make it into something else. And if prices are going down, there's less demand for steel. And that means the economy might be slowing. It's an interesting concept to follow. I'm not sure if it's so accurate these days. We haven't looked at that in a long time. But it did pop back into my head, this remnant from the Greenspan days.
Michael McKee, thank you so much. Again, the bond market moving here in 4 basis points, and the 2-year yield 4.63%, 3.80% on the 10-year yield. At Chapel Hill long ago, Jonathan Pingle studied all of the different Greenspanian details and data on the economy. He joins us now, the chief American economist at UBS. Jim Pingle, I want to cut to the chase, which is to try to recalibrate how far or how close we are to recession. That's the great central bank hope. Is the recession in the distance?
Well, I mean, when I sort of look at the data, and, I can go back to the Greenspanian sort of indicators like rail car loadings, which actually have fallen a lot. But, we are starting to see some of this weakness in demand. Lightweight vehicle sales fell in May about 5%. Even in the CPI data, we've seen 2 months now of new car prices declining. So we'll see what we get on retail sales on Thursday. I mean, tomorrow, we are expecting a rather weak headline number. And that could be indicative of consumers starting to come under a little pressure as they spend out their excess savings. Student loan payments start to resume, as well as still feeling the weight feeding through from the lagged interest rate increases from the Fed. So we do expect in the second half of the year that the nation's probably going to tip into contraction.
Jonathan, I've been struck by the fact that every time someone starts to say, we're going to see the savings run out, we're going to see the consumer start to show more discretion, somebody else pops up and shows an example of how that's absolutely not the case. And I'm thinking about Wells Fargo's CFO yesterday coming out and saying that card spending was up about 10% in April and May. Despite this discretion, how much is this rolling ball of money that keeps flooding into different sectors of the economy just going to roll to another place, but not necessarily go away?
Well, that's certainly been a big part of what we think has kept consumer spending elevated. Now, I mean, real spending over the last 3 months of data annualized is running just 1.1%. So, some of these year-over-year increases are going to look quite gaudy, particularly nominally when we've had a lot of inflation. But, if we look at kind of what's happened since January, consumer spending actually hasn't been all that strong. I understand that the credit card data does, sort of in the year-over-year rates look pretty good. But, if you think about auto sales declining, and I think what we're going to see in retail sales released tomorrow is a bit more softness than what we were seeing, 5, 6, 7 months ago.
Jonathan, we're talking about PPI data coming in softer than expected, which is a good downside surprise for those who want to see inflation come off much more quickly than it has been. How much does this actually end up fueling corporate profits and frankly allow them to continue to increase wages if basically their input prices are coming down, but their output prices can stay where they are or keep going higher based on their pricing power?
Oh, yeah, no, profit margins could be they could be having an important component of sort of nominal wage pressures. I mean, you can imagine that, if you've got elevated profits, you're going to be much more willing as an employer to pass along wage increases in a tight labor market such as this. But, a lot of what's going to come back down to the inflationary pressures is going to be what happens in the broader economy and whether we do get a little bit more incremental weakness. To the extent that consumer spending does slow, it's going to get harder and harder to pass along price increases from the business sector. And I think that's, in fact, kind of really what the Fed's hoping for in both slowing the labor market and in slowing consumer demand growth here.
Is your perceived disinflation a comfortable linear function? Or is it sort of ugly along the way? Like we go down a point and oops, and then another point and a half, oops, and non-linear.
No, you're exactly right, Tom. I mean, that 100%. We have some ebb and flow, let's say, to the disinflation we expect. I mean, we are expecting a pretty fair step down in the June data and the CPI to be released in mid-July and kind of a soft summer. But we are expecting then sort of a rebound in the pace as we kind of head into later in the year. But One of the things that you saw, and Mike was just talking about in the PPI, is, year over year, with energy prices coming down, some of these base effects are going to start to pull down these year over year changes. And I think you'll start to see that this summer as well.
Right.
But in terms of this monthly pace, I'm sure there's going to be some bumps in the road.
One final question. This is really, really important, John Pingle. Just simply, does the Fed do policy based off a barrel of Brent crude, West Texas Intermediate crude, or dare I say a gallon of gas?
So I would argue no. I think that they tend to look through energy prices to some extent. Now, energy prices will feed through to core prices over time, but I think for the most part, there's not a lot they can do about the price of crude, whereas I think what they are worried about is much more the sort of wage price pass-through that risks unfolding as long as inflation stays elevated.
Jonathan Pingle, UBS, thank you so much. They're Chief U.S. Economist. I think, Lisa, it's really, really good to talk to these guys that really keep track of the beans. There's the equation for GDP. And the basic idea here of just you got to go back every once in a while and say, what's consumption doing? What's business investment doing? Even what's exports, imports doing? And the answer is nobody has a clue. We quote this number, Atlanta GDP. We don't have a clue.
Well, remember at the beginning of the year, a lot of companies ratcheted back their capital expenditures. And we saw that consumer spending continue to hang in there and actually increase. And then all these companies who were behind the eight ball, they basically had to come out and reinvest, even if there was uncertainty. And how much is that going to prolong this cycle? And these are some of the sort of vagaries of human emotion and the uncertainty versus the reality of people still having money and spending it.
And McKee, the line of the PPI, there's like 8 lines to PPI. The one he had a revision of disinflation as well. So it wasn't just, a single statistic.
I do keep thinking about the mortgage applications earlier this morning, though.
I missed that. Tell me.
They came out, increased 7.2%. So on the flip side, you see these areas that have bottomed out, like housing, starting to creep back up there as people realize they kind of have to get on it, given that they need a place to live.
Aren't we so sheltered from this because we live in Manhattan? I don't think you and I have a clue what the American real estate market looks like. I just think we live in such an oddity.
I think everyone lives in their own oddity right now. What you're seeing is each municipality is very different from one another in the U.S.
Look at the data here. NASDAQ up nicely, a little red on the screen with the Dow Jones Industrial Average as well. In 4 basis points in the 2-year yield. It's no question about it. If you're joining the program, the S&P up 1%.
Right now, I'm looking at what's going on and expectations for the Fed coming out later this afternoon. And Tom, what's your takeaway from today? Honestly, what have you kind of thought of as the main thrust of the tension at today's 230%?
The tension with 230 is going to. First of all, it is historic. And to me, the arch tension, and this goes back to just basics, which is in each and every economic report and each guest we talk to, is how much of this is normal economics and how much of this is on a supply side nature is a basic phrase, is pandemic induced. And I would suggest Powell's going to come out early in the press conference and recapitulate that this nation is still affected by what we lived with for 3 years.
So Ben Bernanke and Olivier Blanchard put out a paper, a jointly authored paper, where they talked about how initially it was supply-side constraints that fueled the inflation and how it's shifted. And now it's really being driven by the wage side, by the labor market tightness. And they talked about how that shift is making it much more difficult for the Fed because they have to see unemployment rise in order to bring inflation lower based on what the main driver is right now.
My book of the summer is Olivier Blanchard. I'll get that back out here to recapitulate, get to July as well. But the basic idea here is simple. Professor Blanchard looks for other factors to overlay on top of the daily babble we talk about. And one of them is the use of technology, which goes back to what we've seen in the stock market.
Yeah, so you asked earlier, what makes people capitulate on their bearishness? They just say, AI, I'm done. I'm now all in.
Randall Krosner, Diane Swank, other worthies will be with us here at 1:30, a most interesting Fed meeting. Stay with us. This is Bloomberg Surveillance. Good morning.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country? Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
I think we gain and China gain from trade and investment that is as open as possible, and it would be disastrous for us to attempt to decouple from China. I certainly do not think it is in our interest to stifle the economic progress of the Chinese people.
The Treasury Secretary of the United States, former chair of the Fed, Janet Yellen there, and I really want to say that over the years at Bloomberg surveillance, the one person who's driven forward this thought in conversation is Catherine Mann, now at the Bank of England. Professor Mann owns the absolute high ground on the codependencies of China with America. And Lisa, as you heard there from the Secretary of Treasury, and I think Catherine Mann, she wouldn't say it now because she's working for BOE, but Catherine Mann would say, you've got to engage the conversation.
Which perhaps is the reason why Tony Blinken is heading over to Beijing, I believe, on Thursday. We're learning this as he tries to mend ties, perhaps. I'm wondering what the parameters of that are, Tom, at a time when there still is a lot of public pressure to decouple in a way that perhaps policymakers and business leaders don't necessarily feel is realistic.
The statement from State is simple. While in Beijing, the Secretary will meet with senior PRC officials, where he will discuss the importance of maintaining open lines of communication to responsibly manage the U.S.-PRC relationship. He looks for potential cooperation on shared it's a lot of verbs and syllables, transnational challenges. Joining us, someone who speaks clearer than me, Anne-Marie Hordern, our Bloomberg Washington correspondent. We're thrilled to bring in Damian Sassower, Chief Emerging Market and China Credit Strategist for Bloomberg Intelligence. Anne-Marie, to you is first. This is not a surprise, is it?
No, it's not. Actually, myself and Jenny Leonard were the first to report about his trip, and now the State Department confirming our scoop with the dates of Secretary Blinken heading at the end of the week to Beijing. This is the first time as Secretary of State he has taken this trip, and this is a long time in the making. Remember, one of the deliverables when Xi Jinping and President Biden sat down in Bali at the G20 was that Secretary of State Blinken would head to China. That trip was then on the books in February, and he was still set to go when the White House knew there was this spy balloon flying over the continental U.S. But then obviously politically it became very toxic when images of that spy balloon surfaced, and he had to cancel his trip. And then we had a fresh low of relations between Washington and Beijing. So now he is finally going, and likely this could potentially open the door for other such trips. Remember, I also sat down recently with the Treasury Secretary, and she said her plans were as well to still go and visit her counterpart in China.
How will it be greeted? Will it be a rote foreign policy diplomatic mission, or will you look for something more than that, perhaps like we saw with Kissinger with Nixon a few years back?
I think this is really just an opening of the window and the door, and to try to put some guardrails under the relationship. I think it's also interesting at the same time this week, you have the Treasury Secretary of State heading to China. You also have Jake Sullivan, the president's national security advisor. He's in India, but he's also going to Japan as well. You can see the administration is really starting to put a lot of emphasis, especially as we already are over a year into Russia's invasion of Ukraine. They've done a lot of work with Europe. They are really starting to put a lot of emphasis on Asia Pacific.
Which focuses a lot of people on who has the leverage. And Damian Sassower, I'm curious from your vantage point, we're talking about the U.S. making outreaches to China at a time when they're convening business leaders with urgency to try to get a handle on how to support the economy. Where is the balance of leverage here? What's the backdrop in China amid some of these potential talks?
No, I think Anne-Marie's right to point out the timing around this meeting, and the timing couldn't be more perfect considering we have activity data coming out at 10 o'clock tonight. Oh, but an hour before that at 9 o'clock this evening, the PBOC is likely to cut rates by 10 bips. Now, here's the thing. This is all about China and CNH becoming a funding currency, right? I mean, if you look at the negative carry embedded within China, that's why you have foreigners selling CGBs. That's why you have the CNH weakening to 715. You have onshore corporates who are flush with dollars, not defending the yuan because of the policy ambiguity that's been going on, not just between China and the U.S., but writ large across, most of the developed market regime. So I think right now, given where we are, given the data that's coming out, I think China's right to make an overture toward the U.S. and try to rectify the ship.
Do you feel like, or not feel, but is the sense on the street that China right now has enough pressure on it to try to make more concrete overtures than they've made since the pandemic, when there have been some true profound shifts in policy and, frankly, social approach by Xi Jinping?
Well, we haven't seen real, action of that yet. I mean, we have heard about them convening, the PBOC Yin Gang, convening business leaders to ask their opinion on what we can do to get animal sentiments back. On the right ship in China because the economy is flat on its back. And that has everything to do with the property sector. And it seems to me this time around, China's not willing to stimulate the property sector as they have in years past. And so what does that mean? It means that they're going to have to pivot to more of an export-oriented approach, hence the U.S.
Anne-Marie, diplomatically, are we traveling to Beijing realizing that China, from Mr. Sassower, is, quote, flat on its back?
Well, I think what you want to see from the State Department is they're trying to have more of a diplomatic overture. I really think this administration is trying to put guardrails on this relationship. But yeah, they obviously see the concerns that are going on domestically in China. I think for the State Department, what they're concerned about is what happened most recently in Singapore, where there's this cordial handshake between the two military chiefs, the two biggest economies in the world, but that was it. There was no real dialogue. At the same time, you had a Chinese vessel and a U.S. warship coming very close together. They want to mitigate these risks.
Right. Damian, is the Chinese banking system sound?
Well, no, not at all. Actually, I think what we've seen here is we've seen property developers. It's then matriculated into local government finance vehicles. And now we're seeing municipal governments, right, really feel the pain here. And so, for me, this is fiscal fragility in China. And I don't see it getting any better unless we see some really, really big shifts on the policy front.
I just want to say, Lisa, that Liz Economy, who's now with Raimondo over at Commerce, she nailed this. Elizabeth Economy absolutely nailed this fragility in China.
Which shows why some of these policymakers may want to come to the table with the U.S. But Anne-Marie, one thing we have consistently talked about, and I find this fascinating, policymakers and business leaders want to see the relationships mended a bit more, perhaps, than public sentiment on both sides, where you have basically catering to the population saying, we're hardening our line with the other entity. How much is that factoring into the discussions that we expect to hear coming in the next week or so?
Well, it's difficult because the rhetoric, the political rhetoric from Washington is very, very hot when it comes to China. And that is only going to increase as we head towards November of 2024. And there's a presidential election from both sides. They are going to want to make sure they are talking tough and taking a tough stance on China. At the same time, you have the administration also potentially readying new provisions and new penalties they can use on China. We've already seen this administration keep the Trump-era tariffs. They've had a number of export controls put on China. And at the same time, we're still waiting on details about this outbound investment restriction that obviously potentially can hurt U.S. businesses, which is why the administration at the G7 was trying to shore up European partners on it. So they are trying to put guardrails on a relationship at the same time that they are also looking to put penalties in some places on China, and at the same time try not to get the blowback from Republicans, especially as this is a president that's running for 2024.
Emery Horton, thank you so much in Washington. With us, Damian Cesar here on EM, and I only have one final question as we close out the hour and move forward on a Fed day as well. It is widely mandated on page 42 of my agreement with Bloomberg that there can be no Yankee garb on set.
Whoa!
You show up with a Yankee tie today?
Well, I'm not pointing fingers at the Red Sox, although we do play you this weekend. But we've got a big ace pitching matchup tonight. Yankees, Mets, Garrett Cole, Justin Verlander. It's going to be a great game. I'm going to be switching between that and the China data here on Bloomberg, the activity data, and
you'd be in the third row with Keith Olbermann. I mean, there's a must-attend game.
Legend seats only, Tom.
All I can say is you let Anne-Marie go way too early. She would have heckled me nonstop of how about those Yankees last night. I saw that, Anne-Marie.
What do you think? The Mets have lost 42 in a row.
Whatever,
you
it doesn't matter.
Sam Cohen yesterday, right?
Yeah. All I can say is don't do that again.
Okay, sorry.
Yankees Mets here on the desk as we close out an interesting hour. Cesar will not be attending our Fed show this afternoon. That is for sure. Anne-Marie Horton on short notice there on an important announcement from the State Department in Washington. Blinken will travel to China. We will travel to the Fed show this afternoon. Our usual lineup of worthies. I really can't say enough how I think it's going to be a value add. And of course, we'll be watching those markets into the close. Right now, red and green on the screen, a little bit of a lift. It's quiet before a Fed meeting. We say good morning on radio and television. This is Bloomberg Surveillance.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
In New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So $1 there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
It is Fed decision day. Live from New York City this morning. Good morning, good morning. Your equity market just about positive by 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the Federal Reserve gearing up for a pause as inflation data shows signs of improvement. Equity markets rallying to new highs for the year. We begin with the big issue. Chair Powell up next.
I think the Fed skips.
Definitely a skip. Skip. A hawkish skip.
Hawkish skip. Jerome Powell's been very clear about that.
The messaging around skipping is really important.
We're going to skip now and hike after that.
I think it turns into a pause.
The Fed wants to preserve optionality. They have to be flexible.
You should expect the median dot to go up.
Well, we're likely to see a higher median dot.
They're going to try to signal that they're really not thinking about the next stage.
The best policy prescription at this point is patience.
The Fed really wants to buy itself as much time as possible.
They're just going through this week by week.
Markets have to sort of wait and see as the Fed kind of digests data.
Work is not done yet.
The Fed has to do more work later this year.
Joining us now to discuss, Greg Peters of PGIM, JP Morgan's Bob Michael. Gents, fantastic to catch up with you both. Bob Michael, what will it be a little bit later this afternoon?
Well, I'm looking for three things from the Fed. The first is, what are they going to do with policy rates? I'm sorry to introduce a new word, but I think they're going to hold where they are. The second thing I'm looking for are the summary of economic projections on future Fed policy rates. I think there will be a pretty wide dispersion. I'm anxious to see how many are on hold through the balance of the year versus how many are looking for higher rates. And then lastly, it's got to be a lively press conference.
Greg Peters, how divided is this committee going to be today?
Well, I think it's pretty divided, but maybe not as divided as many think. Everyone's following the data. Investors are getting very excited around the CPI and PPI prints rolling over. But the Fed modeling and the markets are anticipating that to run out of steam. And so I know the word transitory is no longer in vogue, but I think if you actually model inflation going forward, this decline has a lot more kind of transitory qualities to it than I think the markets are actually appreciating.
Greg, just to be clear here, you think the decline, the disinflation is transitory?
Correct. And so if you look at two major factors, right, if you look at, OER and then medical research, both of those two items have been trending lower. That starts to, run out, so to speak, and bottom out at the end of this year. And so there's a real chance that those items start to move back up again, thereby kind of confusing markets and putting the Fed very much back into position to continue the hike.
This is something Andrew Hollenhorst of Citi is thinking about. He, by the way, is still looking for a hike a little bit later on today. He's looking for 25 basis points. Andrew says this: if the Fed does skip a hike in June, we would expect some hawkish surprise at some point as underlying inflation remains, here's an interesting phrase, stably too strong. But Michael, what are your thoughts on that and what Greg just said?
Well, I think Greg and I see the same glass. He sees it as half full with inflation. I see it as half empty. I think it was a glass that started full of inflation a year ago and has been draining away. That continues. I don't think it refills up. Greg pointed out the rent of shelter. That's been coming down. That's been sticky in the core. I don't know what turns that around. Is it higher mortgage rates? I doubt it. Is it the consumer stuck with higher prices? The fact that they don't go up doesn't mean that they're going to come down, but the year over year on inflation will improve. And the other thing in the core rate that has been pretty sticky has been used auto prices. But to us, when we look at wholesale prices, that looks to be coming down too. I think the disinflationary trend is intact, and I think some of the things we've seen in the labor market with the unemployment rate going up and claims going up, those are ominous signs ahead for the economy.
Greg Peters, your response?
No, I think Bob, of course, brings up a good point. I guess the difference is where does it bottom out? And then more importantly, what's being priced in the market? So think about what the market is pricing. The market is pricing kind of a peak Fed funds, just call it, 530, so one more hike, and then a series of cuts. And so the question on the table is not about, half full or half empty, is what the markets are pricing. And I think the markets are pricing in a very different future inflation dynamic, thereby allowing the Fed to cut interest rates. And so if you take the other side of that from a market pricing perspective, that's where I get a little more concerned.
Well, let's compare that to what the Fed's projecting. Let's work through the summary of projections together, Bob. Year-end PCE, 3.3%. Unemployment, 4.5. GDP, 0.4. Year-end median dot, basically where Fed funds is right now. How do you expect that to change this afternoon, Bob?
Well, unemployment at 4.5% is recession. The low is 3.4. I don't think there's ever been a jump of 1.1% in unemployment, and the NBER hasn't come in and said we're in recession. So the Fed is predicting recession there. Look, I think they've got to send a message that they're holding where they are. They're going to evaluate data. As Greg said, they want to maintain the optionality. I think they'll point to a little bit better employment than is in their current dot plot, and I think they'll also point to a firmer economy, and I won't believe any of it.
Greg, are you expecting the same thing, and will you believe it?
I am. I am. I think you'll see marginally higher median rate in the back end. I think you'll have inflation come down a skosh as well, and I think you'll have a stronger economy. And I think the labor projection is probably too negative, and that has to be adjusted as well. So I think there's lots of adjustments, but to Bob's point, I don't think anyone really takes those at face value per se, but it does just shine a light on the uncertainty more than anything else.
Yeah, Mike McKee's got to work with it. He's going to be in the room with Chairman Powell at about 2:30 Eastern time. Mike McKee joins us now. Morning, Mike.
Morning, John. The Fed minutes are always full of several, few, many, etc. I'm wondering what Greg skosh actually means, if there's a translation for that. We got a skosh of a move down in the PPI today, which just makes the case for the Fed to be able to skip this meeting. Headline PPI actually contracted by 0.1%, and we saw core PPI, including trade services, flat on the month. The year-over-year PPI comes in at 1.1%. That's the lowest outside of the pandemic since 2016. So that leaves us with what the Fed says, since we've pretty much figured out what we think they're going to do. And the first thing that people are going to look at is the statement to see if they are pledging anything for July. The feeling is they could leave this. I won't read the whole thing here, but basically they're saying the committee will take into account the cumulative tightening of policy, etc., in determining the extent to which additional policy firming may be appropriate. And that may be considered a hint enough. If they go any farther, then maybe they lose a little bit of flexibility. But that's the first thing everybody's going to look at today. The second thing that everybody's going to look at today, of course, is the dot plot. Remember, we've talked about this a lot, that even though we're at the median dot now, 7 members of the Open Market Committee had said that they thought the median dot should be higher, that the Fed should be higher. So we'll see what changes in that. That could be the signal in itself if we see a number of dots move up and the median becomes, say, 5.5 instead of 5.25. So a lot to look at. And of course, as always on Fed Day, I'm waiting for Bob Michael's question.
Well, Bob Michael, it's over to you.
Well, I think, Mike, if you go last, you got to ask the question that we're all wondering about. What do their models tell them on just how much tightening and for how long is needed to drain a couple years of infinite free money from the system? I don't think you'll get away with it. So I think you got to go back to one of the things you touched on, which is they talk about long and variable. They've conditioned us for that. We do think they're going to be on hold. So how do they weigh the risk rewards of having to do additional tightening versus just leaving the rate at where it is for longer?
Mike?
I will put those on my list. I thought Bob was going to say, when he said if I go last, I should ask about the Grateful Dead or Dead and Company and Jay Powell's attendance at the concert the other night. I'm sure somebody probably will.
Wasn't there an amazing story behind that, Mike? Didn't the drummer used to know his sister at high school or something like that? There's a connection there to the family.
That. And Powell is a guitar player, so he and Rich Clarida used to get together and do some concerts at the Fed building.
Mike McKee, something I'd rather give and miss. Mike McKee, thank you very much on a Federal Reserve. Greg Peters for the news conference for you a little bit later. Chairman Mike Powell might have to deal with some dissent a little bit later, and I cannot believe this, that we haven't had dissent from a Fed governor since 2005. Greg, is there too much groupthink over at the Federal Reserve?
Well, I think that's always been the case to a large degree. I personally don't think dissent is such a bad thing. I mean, beating folks into submission, is in a committee by nature. I think the cross currents and the long and variable lag debate, all these things should come into play here. So I actually think a dissent and wider distribution of outcomes by the committee members is a sign of health, not the opposite. So that type of worry doesn't really bother me too much, I would say.
We've got to take this convo and push it through the market, so let's get that conversation started. It's overdue. Bob, you had penciled in a cut in September. So two-part question. One, do you still have that penciled in? And two, let's talk about a cash trap. What do you say to people who have been sat in money market funds all year? What should they do?
So let me start by saying our forecast is still for a recession by year end. And we use Bruce Kasman's JP Morgan models a lot, and the modal outcome is still pointing to recession by year end. We have never gone from the last rate hike to recession without the Fed cutting rates before then. So you have never gone into recession, then they started to cut rates. So if everything we're seeing is still telling us recession by year end, then yeah, I'm still sticking with September as the first rate cut. Yeah, I'm getting a little queasy about it, but I think it's still on the table. In terms of the cash trap, that's the conversation we're having with clients. We've had a fairly significant backup in yields. Forget about the Treasury curve. Just look at the aggregate bond market. Back in March, you were buying it close to a 4% yield. Now you're buying it closer to a 5% yield. That's a pretty good value to us. And I know you can get a little bit higher in cash, quarter, maybe 0.5% more in cash. But if we're right, and we've seen the last Fed rate hike, and the market starts pricing in rate cuts, and they start cutting rates, then those cash returns will start to evaporate, and you'll have locked in not only the carry, but you'll get some capital appreciation from your bond portfolios. It's not something people who have invested in bonds are used to over the last 15 years, capital appreciation in bonds, but we should get that.
Greg Peters, thoughts?
Yeah, so we've taken down our recession probability pretty meaningfully. I think the odds of a rate cut into this year is really quite low. I think we're running out of time and distance here. To me, it's somewhat schizophrenic. You have, the market's pricing in a hike and then like an immediate cut in the fourth quarter. That just doesn't feel right to me. I think the underlying strength of the economy is such. The labor market is a great visual into that, is strong. And so, taking the other side. So for us, we think on balance rates should be higher, not lower. On balance, there's a risk that the Fed has to do more, not less. And so, I think it's a great market for fixed income, but not so much capital appreciation, more around roll and carry. So enjoy those yields because that's income coming in the door. And so that's how we're kind of positioning around this.
I know that Bob's itching to get in and respond to that. We'll continue this conversation. Bob Michael, Greg Peters. Equities right now positive by 0.1% on the S&P, 17 minutes away from the open. With some movers, here's Abby.
Beneath that relatively flat surface, John, we do have quite a few movers, starting out with the shares of AMD popping by more than 2% after the chipmaker gave a preview of their AI accelerator chips, arrival basically to the NVIDIA chip that handles all the AI traffic. The street, a little bit of a lukewarm reception. Nonetheless, the stock is popping. Tesla had been up by more than 1% earlier. France is trying to convince Elon Musk to build a Tesla factory in France. The stock, amazingly, John, this is one of those doubles on the year, even for a mega cap. And then finally, United Health Group going in the other direction, along with Humana and some of the other insurers, down nearly 6%. One of their executives said that there's been a rebound in procedures, especially for Medicare, and that could weigh on expenses.
Abby, thank you. We'll stick on Tesla. Tesla on a 13-day winning streak could become 14. Tesla increasing prices once again.
I think there'll be competition in the space because essentially what Tesla's done here is they've open sourced their technology to the industry.
That conversation up next.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
I think there'll be competition in the space because essentially what Tesla's done here is they've open sourced their technology to the industry. There are 40,000 fast chargers in the US. There are 4 million in China. It just gives you a sense of the growth that we're going to see here as we convert from gas cars to electric cars.
For the third time in the past 2 months, Tesla increasing the starting price of its Model Y sports utility vehicle. Tesla stock on a record 13-day winning streak. Dan Ives of Wedbush writing, the sum of the parts story for Tesla now further comes into play with its supercharger network, energy business, AI-driven autonomous path, unmatched battery ecosystem, and increased production scale scope globally. In a nutshell, Musk and Tesla are playing chess. Other automakers are playing checkers. David Welch joins us now for more. David, let's just start on the theme here. Is there one? Prices down, then they're up. What's going on over at Tesla?
Yeah, look, I think Tesla had an issue where inventory was building up a bit, had a lot of capacity coming online, so they had to lower prices to make sure they could sell all the cars that all these new plants could build. And now maybe they've hit a point where car sales are still pretty strong, the consumer is still pretty strong, and they're sneaking in some price increases because, yeah, maybe they've got to make some adjustments after going down so deep. So some of these vehicles, particularly Model Y, they cut prices at least 25%. So they had some room maybe to go up. Maybe they went a little bit too far, and I think that's what we're seeing.
David, is this unique to them, to that brand, to that group, or are we seeing this across the industry?
Yeah, what's interesting is that everybody thought that once we started having semiconductor supplies come back, and they're not all the way back, but they're pretty good right now, you get back to $4,000, $5,000 discounts, and we haven't. Prices are still very strong, still near records. Used car prices have held up. Consumers need cars, and there's still a lot of demand out there. So I don't think you're seeing others sneak in price increases because they haven't done the discounting Tesla has, but they've been holding prices at very strong levels, and I think that's what's going on right now, too.
Hey, David, thank you. David Welch there on the latest out of Detroit. That stock up again this morning. We could have day 14. Over the last 13 days, we've added $240 billion in market cap to Tesla. Just unreal. Greg Peters, Bob Michael back with us. Greg, you talked about inflation. Can we talk about consumer price tolerance? Just how much of that is out there still at the moment?
Well, so, you talk about the Tesla story, and this brings to mind this whole debate around greedflation, right, where companies and corporations are using this as an opportunity to raise prices. It does beg the question of what the tolerance is around kind of consumer on that end, but it seems like there's a lot more tolerance than initially anticipated. And so if you kind of think of it kind of full circle, right, if corporations are looking to raise prices to take advantage of this backdrop, then, this inflation dynamic has perhaps a little more legs to it than initially envisioned.
So you two have a very, very different view on the glide path for inflation from here. And in some ways, in fact, many ways, because of that, a different view on the Federal Reserve too. Can I just finish up by getting your views on credit, Bob? Where does that leave your view right now on high yield, high yield credit in the United States, based on the fact you think recession and rate cuts just around the corner?
Well, we own a ton of credit, but it's high quality credit. It's mostly investment grade. And where we've gone into the high yield market, we've been very conservative. Our view is that when you go into recession, that's when you see the bottom in the credit markets, the wide and high yield spreads. Historically, it's always been 800 basis points over. I think that's still very much on the table. Yesterday, I was talking to a number of people from our alternatives team, and we were talking about private equity, but a lot of private equity transactions starting to crumble because of the cost of funding that's gone into their leverage. Or simply put, they borrowed money maybe at 5% a year, 18 months ago, and as they're rolling it over, if they can roll it over, it's somewhere in the 10 to 15% neighborhood. So it's consuming a lot of their disposable cash. And I think that's a story you see repeatedly about the early stages of credit stress.
Greg, is your view any different?
No, it's oddly similar, right? We have kind of different views of the backdrop, but it's still a market that is leading you towards high quality credit, up in the capital structure, up in rating. We really like structured products as a way to play that. So it looks very attractive vis-a-vis kind of corporate credit. But this is not a market to dive deep down into credit, take a lot of cyclicality risk. But the opportunities are actually pretty immense, not only from a relative value standpoint, but also from just taking what the market gives you. You clip a very good coupon, get a very good yield, and we're actually pretty favorable.
But Greg, I've got 30 seconds left. Help me out with this. You've both got two different views of the world, of inflation, of the Fed, yet you end up in the same trade. Does that make you nervous? You're comfortable with that?
Well, I say we're in the same trade vis-a-vis credit, which is up in quality, and that's really taking advantage of what the market's providing. On the rate side, I suspect it's quite different. But to me, right, if you actually are forecasting a recession, it's really hard to envision an environment where credit spreads hold in well, so you should be wholly out of credit. So, there's probably nuance between Bob and myself, of course, but in general, I think the market is rewarding you for safety, and you should be taking advantage of it.
Well, on the Treasury side, Bob's at 3%. 2s all the way out to 30s and has been there for a number of months looking for that year end. So the two of you, thank you. Bob Michael, Greg Peters, just two of the very best in fixed income on the buy side, just working through some big issues. 7 minutes away from the opening bell in the United States. Equity futures just about positive. Coming up, the morning calls, and later, Victoria Fernandez across Mark on why she's been adding to tech. That conversation just around the corner.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Four-day winning streak on the S&P 500. Let's see if we make it 5. We are about 5 minutes away from the opening bell, with equities just about positive on the S&P. That is the price action. Let's get you some morning calls. Citi downgrading Logitech to neutral, $70 price target, citing uncertainty from the sudden and unexpected departure of the company's CEO. Next up, BTIG raising its price target on Shake Shack to 85 from 75, keeping note a buy rating, seeing the company's adoption of kiosks driving sales growth. And finally, JP Morgan adding Dollar General to its analyst focus list, expecting growth over the next decade. That stock is up by a little more than 2%. Coming up, Tesla adding $240 billion in market cap on a record 13-day winning streak that is about to become 14. Across the marks, Victoria Fernandez joins us around the opening bell on why she has been added to tech.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year, and we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. The moment news breaks, no one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Four-day winning streak on the S&P 500. Will it become 5? The fate of that perhaps in the hands of one-man Chairman Powell, and a news conference taking place a little bit later this afternoon. Equity futures unchanged on the S&P 500, slightly positive on the Nasdaq, slightly negative, and the Russell of small caps just about positive by 0.1%. There's the opening bell, switch of the board and get to the bond market. Yields on quite a trip, quite a ride since the Fed last met in early May. We closed that day, May 3rd, at about 380 on the front end on a 2-year. Added some serious weight to the front end of the curve, up to about 460 this morning, so 80 basis points higher from the last time the Fed met. This dollar has been stronger. It's weaker this morning. Euro dollar positive by 0.4%, 108.37. Crude positive 2, back through 70 this morning. $70 and about 30 cents, up by 1.2%. Around the open then, about 25 seconds in, we are almost totally unchanged on the S&P 500. On the Nasdaq, unchanged as well. One stock that has not been unchanged over the last 13, 14 days, Tesla. The EV maker set to extend gains for a record 14th consecutive session. Morgan Stanley analyst saying, quote, the market wants to believe Tesla is an AI name first, an auto company second. The company also raising the price of its Model Y in the US once again. Ed Ludlow up early for us this morning. Morning, Ed.
Good morning, Jonathan. Tesla is up for a 14th consecutive session, extending that record. We're higher by about 0.3%, but we're bouncing around on the stock. $242 billion of market cap's been added over that 14-session streak. There's some key data points and technical analysis that needs to be done. Tesla's $242 billion market cap gain is greater than the standing market cap of 90% of the members of the NASDAQ 100. So when you reflect on Morgan Stanley and Jonas's call about valuation and the reconsideration that investors are doing, that's probably important to know relative to its index peers. The other part is a technical analysis on a relative strength index basis. 14-day RSI, we're at 88. On a 0 to 100 scale, anything over 70 on an RSI is in overbought territory. So we're deeply into overbought territory. In terms of the news flow, no clear catalyst out there when it comes to Tesla. They did raise the price of Model Y in the US again, this time by about $250. There's also that added momentum around what we're seeing in North America with GM and Ford, but also rival charging infrastructure players saying that they will add the NACS standard to their charging offering. How long does it keep going? Anybody's guess.
Ed, I'd love your perspective as well. I was talking to David Welch about that price hike. It's $250. Have you got an idea of what the price strategy is here now at Tesla?
Just really quick, John, we're now down 0.7% on Tesla. Such is the market, so that's probably worth noting. Who knows where we'll be at the close. Pricing has always been a lever for Tesla. You know, that Elon Musk has talked pretty consistently that in order to protect growth and volume, they're happy to sacrifice profits. You know, at the beginning of the year, they cut prices to great effect and unlocked a pocket of demand in January. Elon Musk talks about demand being twice the rate of production after they had cut prices. Now we've seen them ramp back up again. $47,740 is the starting price for a Y. You compare that to the US median or mean average price of a new vehicle, it's still slightly below, so it makes them competitive. It's a lever.
Ed, we're softer, just a little bit. Ed Ludlow, thank you. We're down by about 0.5%. 13-day winning streak before today. More than $200 billion of market cap added to that stock. We mentioned Adam Jonas of Morgan Stanley, still overweight Tesla. He wrote this. Here's the fuller quote. The market wants to believe Tesla is an AI name first, auto company second. Suspect many investors may be again looking at ways to justify the valuation beyond the confines of a unit price automatic hardware model. Just amazing to see what this name has done over the last few weeks, that's for sure. Let's turn to the chip makers. AMD giving investors a peek at its upcoming line of, guess what, AI processors. As demand continues to heat up, the company planning to introduce a product that speeds up processing for generative AI like ChatGPT. Abby has more. Hey, Abby.
Yeah, it's hard to get away from AI at this point, John. And this stock has really been all over the map relative to this event and the unveiling of this processor yesterday after the event. Down about 3% earlier in the pre-market, up nearly 3% moments ago, up just fractionally. Right now, up less than 1%. So investors trying to figure out what it means, but essentially what you were talking about, these processors are meant to handle all of the traffic that comes in from the generative AI. CEO Lisa Su saying it's going to be a huge, huge market, $150 billion in potential. Their key customers will start sampling the technology in the third quarter. Analysts somewhat positive, saying that this puts them in the league with NVIDIA. NVIDIA, by the way, does have that $1 trillion market cap, even though it's down slightly right now. So it's hard, again, to get away from AI. AMD now officially in the game.
Up 1%. Abby, thank you. You just have to say the words AI, the letters AI, and all of a sudden you generate a bit of a rally. We mentioned NVIDIA. Let's talk about it. NVIDIA in the spotlight over share buybacks. Isabel Lee has the story. Hey, Isabel.
Hi, John. Many in Wall Street do love to dig into the reasons behind buybacks. But yes, this is sparking chatter, especially after the last fiscal year. So NVIDIA, after a 3-year break, decided to spend more than $10 billion repurchasing their shares after a monster rally ahead of AI, which, to Abby's point, NVIDIA has hit the $1 trillion club, which is only the 7th company in the U.S. to close in that valuation. So in hindsight, this was a fantastic timing because shares have since doubled since then. And so now, despite having more than $7 billion in rebuyback authorization, NVIDIA isn't doing anything. And some are saying this is a warning sign, while some are also saying maybe they just want to have a little cash on hand, John.
Why would they? Isabel, thank you. They made the decision hundreds of millions of dollars of a market cap ago. Isabel, thanks again. The stock is basically unchanged. I want to turn to healthcare. Some of this healthcare news is slightly depressing. United Health seeing higher costs as seniors catch up on surgeries delayed by the pandemic. The CEO speaking at an investor conference saying, we're seeing, as behaviors kind of normalize across the country in a lot of different ways, that more seniors are just more comfortable accessing services for things that they might have pushed off a bit, like knees and hips. Katie has more. Hey, Katie.
Hey, John. Well, that catch-up in surgeries is bad news for the insurers, including, of course, for United Health, which is the biggest of the group. Shares currently down about 8.7% and 8.8% at the moment this morning after that investor conference. Since an increase in surgeries, such as those joint replacements that you mentioned, usually mean higher expenses and higher premiums. You also had the CFO, John Rex, warning that second quarter premium revenue spent on that type of care may be at the upper end or, quote, moderately above expectations. And that warning, it's leaving its rivals lower as well. If you look at Humana and you look at CVS, and at its heart, this is a pandemic story, since according to RBC, these are the types of procedures that were basically deferred over the past few years, particularly among Medicare Advantage patients. And now that pent-up demand looks like it's going to push up costs for those insurers as well. Quick check again on United Health, currently off by more than 8%.
The wrong kind of pent-up demand there. Katie, thank you. Katie on the latest with the healthcare providers. The market right now, about 7 minutes into the session, more broadly, still totally unchanged on the S&P, going into the Federal Reserve decision later on this afternoon. After hiking interest rates for 10 consecutive meetings, the Fed is potentially gearing up to take a pass on today's meeting. It would make it the first pause since the day the hiking cycle began on March 16th last year. That day, the S&P 500 closed at 43.57. An aggressive 500 basis points later, after rallying through 3 of the biggest bank failures since 2008, a bear market became a bull, and this market closed yesterday at 43.69. Victoria Fernandez across Smart Global Investments joins us now. Victoria, it's like the hiking cycle never happened, isn't it?
Yeah, it is. I mean, according to the equity markets, like you said, we're back where we were almost a year ago. But I think it's a sign that in the equity market's mind, the Fed is coming to an end of what they need to do of the rate hikes in order to tamp down inflation. I'm not sure I 100% agree with that. You know, there's a question in regards to what it means for the Fed to tamp down inflation. Are they going back down to 2%? If so, they still have a long ways to go, and the market's going to have to reprice some of what they think right now. I don't think they'll anticipate going all the way down to 2%, but I'm actually in the camp that I'm not so sure the Fed is done. I know that the futures is pricing in a 25 basis point hike at July meeting, but I still think they might go further. And I think the dot plot today is going to give us a good look into that. If they raise their expectations to where the IMF came out earlier this week and was putting growth expectations, then that means 2 more rate hikes at least. So we'll see what happens. I think this afternoon could be interesting.
With that in mind, do you think this chairman cares about looser financial conditions, higher equity prices?
Well, I think he does care about financial conditions. And, you know, this is part of the reason that I think the Fed is not done yet. When we look back over the last few months, what are some of the things that were coming to fruition where the market said, look, the Fed can take a pause because we're getting tighter financial conditions? We had the banking crisis. We had housing doing poorly. We had spreads starting to widen out a little bit. All of that has changed. We've got bank lending moving back up to where it was prior to March. You've got housing turning around, and housing prices, Jonathan, lead rents. So if everyone is anticipating rents coming down, and it makes up 40% of the CPI number, it looks like rents could start to creep back up again. We've got spreads tightening, equity market higher. So financial conditions are actually easing. That goes exactly against what the Fed wants to do. So I think they are paying attention to it, and it could set us up for a more hawkish stance than maybe what people think.
This is almost exactly what Greg Peters of PGIM was alluding to in the last 30 minutes, Victoria, which makes me ask the question then, just reading through your notes, why have you been adding to tech if that's what you think is going to happen over the next few months, the next few quarters?
So, you know, I think everyone believes that if someone is bearish, that they're completely out of the market. And that's not where we have been. We do think that we're going to get, whether you call it a pullback, a mild recession, whatever you want to label it later this year. But that doesn't mean that we're out of the market. We're trying to find places within the market that have some opportunity. And part of portfolio management is to have risk parameters around your decision making. Our risk parameter was telling us we were too underweight on some of the tech names. So we were adding a little bit to names. Salesforce pulled back. We added a little bit to that. Alphabet pulled back. So we added a little bit more to that. We're still underweight in tech, and especially in certain names, but that doesn't mean that we don't want some exposure there. We just are still a little bit underweight and are trying to find other areas in the market that we think can have a better leg forward as we go to the end of the year.
Do you subscribe to the theory pushed by the likes of David Kostin and Goldman Sachs that this rally can broaden out?
Well, we've seen it, right? Over the last couple of weeks, breadth was a huge concern for us. And we actually talked about that last time we were together in regards to such a small percentage of the Russell 3000 being above their 20-day highs. We've seen that broaden out, and that's a positive sign. I don't want to negate some of the positive elements that are in the market. I just think it's not enough at this time when you still have 13 continual months of leading economic indicators coming down, 12 months of an inverted yield curve, still waiting for the effects of 500 basis points to work its way through the economy, wages staying higher, unit labor costs going higher. I just think you have to look at the whole picture. And in that whole picture, it tells me, yes, there's some positive elements like breadth improving, but there's still a lot of negative signs out there that tell us we need to be cautious with our clients until we get through the end of the year.
So let's say I'm a client, I call you up, I've been stuck in cash all year. Tom Keene made me do it. I want to put some money to work in the equity market, I've missed the rip. What are you telling those people now?
Yeah, so we're actually telling our clients that we need to have that diversification in your overall portfolio. Hopefully, you know, being in cash, at least if you were in a money market fund or a treasury fund that was giving you 5%, at least it gave you a little bit of a cushion there. So you can have a little bit in cash. You can invest in the fixed income market and get 5.5% on short-term treasury bills. But I think in the equity market, you want to look at some elements that have been downtrodden. Look at a name like a McKesson in healthcare that has that, as you talked about a moment ago, an AI component because it's healthcare information technology. You can look at some of those tech names that have pulled back, but I also think you need to build a little bit in those staples, especially since they've pulled back, a name like a General Mills or a Kimberly-Clark that will continue to do well, even as we go into the volatility we think we'll have fourth quarter of this year.
Help me understand what's going to happen here. If I listen to you correctly, you're still expecting a recession, potentially seeing this inflation downdraft as somewhat of a head fake, to use a word that Greg Peters used earlier, transitory. So sticky inflation, softer growth profile, where's that going to leave the margins of some of these companies?
It's going to leave it pretty tricky. You look at productivity falling. We look at wages continuing to do well. And even if you don't want to just take wages straight from the labor report, look at the Atlanta Fed wage tracker. That's telling you that wages are sticky right now. And it's not just in certain sectors, it's across the board. So you have unit labor costs going up. That compresses margins pretty dramatically. And we've actually had 2 negative quarters of earnings, right? We're in an earnings recession. I think the margins will continue to be compressed, even though you have a consumer that continues to spend. The pricing power, we've heard in earnings calls, pricing power is dissipating for some of these companies, and that can lead to layoffs. That's where you get that weakening in the labor market, and it flows through from there. So it's kind of a snowball effect, but I think it starts with low productivity, higher wages, and goes from there in regards to margins.
If you are just tuning in, about 14 minutes into the session, this equity market almost totally unchanged. Victoria Fernandez across Mark still with us. Victoria, just a final topic for us to go through. Federal Reserve later, Chairman Powell this afternoon. What are you expecting from the Chairman of the Fed a little bit later?
So your question is, what do I expect them to do? I expect them to actually skip this meeting and maybe go back into the 2018 mode of skip a meeting and then hike at the next meeting, skip a meeting, hike at a meeting. Maybe that's what they start to do in order to make their way towards a pause. If I was on the Fed, though, I would actually be voting for a hike at this meeting. I think they're playing a very dangerous game with financial conditions easing instead of tightening, a still pretty decent labor force, consumers still spending. I think they're playing a dangerous game and thinking that inflation is going to stay where it is or come down. It could move higher, and they need to nip that in the bud now instead of waiting and seeing it come even more later.
Would you expect some dissent later on this afternoon then when that statement drops?
I do. I think there will be some dissent, and I hope there are, because it tells me that there's some good conversations going on there as to a basis point hike in July.
It's a skip, but right now the Fed does not want to call it the end. Victoria Fernandez,
right.
Thank you. Just why they don't like this word pause right now. It's a 3-part act. We get the statement, you get the projections, the summary of economic projections, unemployment, inflation, growth, and a projection in there as well about where they see the future of the federal funds rate too. Look out for the median dot. Then it's on to the news conference with Chairman Powell at 2:30 Eastern time. About 16 minutes into the session, waiting for all of that. The S&P, some muted price action, positive by 0.1% on the S&P. On the Nasdaq, a very similar move. Coming up on this program, where the drama has been, former President Donald Trump delivering his defense.
This is called election interference and yet another attempt to rig and steal a presidential election. I had every right to have these documents.
The former president on the campaign trail, that conversation up next.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media. Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From the Wizards and Capitals to new ventures and innovative investment, running a sports empire in Washington, D.C. is a monumental task. Owner Ted Leonsis trusts CFO Peter Bichet to execute monumental sports and entertainment's financial game plan.
We are definitely in growth mode. What else can we do? How do we grow the platform?
Watch Chief Future Officer today on Bloomberg.
The most evil and heinous abuse of power in the history of our country. This is called election interference in yet another attempt to rig and steal a presidential election. It's a political persecution like something straight out of a fascist or a communist nation. This day will go down in infamy, and Joe Biden will forever be remembered as not only the most corrupt president in the history of our country, but the president who, together with a band of his closest thugs, misfits, and Marxists, tried to destroy American democracy.
Former President Trump on the offensive, speaking to supporters at his Bedminster Golf Resort after pleading not guilty to federal charges for allegedly mishandling classified materials. Democratic lawmakers are pushing back.
As we all know, in America, nobody is above the law, not even a former president. And I think that the American people, regardless of where they stand on Donald Trump, former President Trump, should allow the process to play out through the court system in a peaceful manner.
Very serious issues. Joining us now is AMH down in Washington, D.C. Anne-Marie, quite a 24 hours.
Yeah, it was. And Jonathan, we should note it's not just Democratic lawmakers that are pushing back. I have a list here. Senator Lisa Murkowski, Shelley Moore Caputo, Tim Scott also wants to be the candidate, though, for 2024. Pretty damning, serious charges, serious allegations. You can see the rhetoric is starting to ramp up, at least when it comes to the charges, although many also continue to say that they want to look at how they believe, at least from the Republican side, that they think the Department of Justice may be weaponized. When it comes to the former president, after he was arrested yesterday and he made this pit stop, which really felt like a campaign rally and then a speech, This was a little bit, Jonathan, of a window into his defense. He said these boxes were containing all types of personal belongings, many, many shirts, shoes, everything. I hadn't had a chance to go through all the boxes. It's a long, tedious job, takes a long time, which I was prepared to do, but I have a very busy life. I'm sure his legal counsel does not want him openly talking about the case, but potentially you can see the kind of rhetoric and the pushback the former president is going to have, because he is not just a former president that now is under indictment and arrested and has to face these federal charges. He is also campaigning to try to be the candidate for 2024.
Anne-Marie, as you said, it feels like one big campaign. It's not. It's a court case. What's the timeline for it now?
Well, we're still TBD, Jonathan. There's going to be a number of motions, I imagine, the Trump team is going to make to try to slow down the process. They want to have this be a long, drawn-out process. The former president, in terms of a lot of reporting out there, is still trying to boost up his legal team, especially trying to find a lawyer who has a specialty when it comes to national security concerns, given the number of accounts against him have to do with the Espionage Act. The one date to look forward to at the moment, Jonathan, is June 27th. And so far, that is the only date we know, and that is a hearing for his co-defendant, Walt Nauta, but not in terms of when we're going to see the next steps when it comes to the former president.
AMH, thank you. On the latest, let's get you the latest price action. About 23 minutes into the session, more broadly on the S&P, we're positive by 0.2% on the S&P 500. On the NASDAQ, we're up by 0.2% as well. The chairman of the Federal Reserve just around the corner. Your Fed decision just hours away. Your trading diary up next.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Minutes into the session, equities positive for a fifth day so far. Let's see what happens later on this afternoon. That's the price action, because later on today, we've got the Chairman Powell Fed decision and a Federal Reserve news conference as well. Let's get to the trading diary. We look a little something like this. Tomorrow, we get retail sales and another round of jobless claims, plus the ECB's rate decision. On Friday, we round out the week with UMich sentiment and the BOJ rate decision as well. Tons to get through the next 48 hours, tons to get through the next several hours as well. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in prize stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today. And then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can